Question 1. A wraparound mortgage is best described as option A. A construction draw loan option B. A junior loan that includes the existing first mortgage balance plus additional financing option C. A mortgage with only escrow payments option D. A loan that replaces the first mortgage completely. Take a moment to choose your answer. The correct answer is option B. A junior loan that includes the existing first mortgage balance plus additional financing explanation. B wraparound. B wraps the existing first mortgage, borrower pays wrap lender, who pays the underlying first P. Question 2. A key risk in a wraparound mortgage is option A. Escrow is prohibited option B. If the wrap lender fails to pay the underlying first mortgage, default can occur option C. The borrower cannot legally own property option D. The rate can never change. Take a moment to choose your answer. The correct answer is option B. If the wrap lender fails to pay the underlying first mortgage, default can occur explanation. P. If underlying payments aren't made, the first mortgage can default even if borrower paid the wrap lender P. Question 3. In many wraparound arrangements, the borrower typically pays option A. No one option B. Only the original first lender option C. The wrap lender, who then pays the original first lender option D. Only the escrow company. Take a moment to choose your answer. The correct answer is option C. The wrap lender, who then pays the original first lender explanation. P. Typical flow. Borrower pays B. The wrap lender B. Wrap lender continues paying the underlying first P. Question 4. Which borrower is most likely exempt from paying the VA funding fee? Option A. A veteran receiving VA disability compensation option B. A first-time VA borrower option C. A borrower with a 760 credit score option D. A borrower making a 5% down payment. Take a moment to choose your answer. The correct answer is option A. A veteran receiving VA disability compensation explanation. B. Correct. B. Answer 2. P. Veterans receiving B. VA disability compensation B. and certain eligible surviving spouses are generally B. exempt B. from the VA funding fee. B. Why this is tested. B. Many students confuse the funding fee with down payment or credit score. Exemption is tied to B. disability status B. not credit score or down payment size. B. Why others are wrong. Lead down payment does not automatically create an exemption. High credit score does not exempt the fee. First time use affects the fee amount but does not automatically exempt it. B. Exam clue. B. disability compensation equals B. funding fee exempt. B. furious smileys. P. Question 5. Which document is used to verify a borrower's VA loan eligibility? Option A. Closing disclosure, CD. Option B. HUD-1 settlement statement. Option C. Truth in lending disclosure. Option D. Certificate of eligibility, COE. Take a moment to choose your answer. The correct answer is option D. Certificate of eligibility, COE. Explanation. B. Correct. B. Answer 2. B. Certificate of eligibility, COE. B. proves that the borrower meets VA service requirements. It confirms the borrower's eligibility and available entitlement. P B why others are wrong B PEUL B C D B greater than a final closing disclosure required by TRID, not proof of VA eligibility. B HUD 1 B generally replaced by the CD for most residential loans. B TIL disclosure B greater than a consumer disclosure about April finance charges, not eligibility. ULD P B exam clue B eligibility for VA equals a B COE a B furious smileys P. Question 6. Which occupancy requirement applies to VA loans? Option A. The borrower must occupy the property as a primary residence. Option B. The borrower may rent the property immediately. Option C. Occupancy is optional if the borrower has full entitlement. Option D. The property must be a vacation home. Take a moment to choose your answer. The correct answer is option A. The borrower must occupy the property as a primary residence. Explanation. P. B. Correct. B. Answer 2. VA loans are intended for B. primary residences. B. Borrowers must certify intent to occupy the property, typically within about 60 days of closing. B. Why this matters. VA benefits are designed to support home ownership for service members, not investment-only purchases. B. Why others are wrong. B. Vacation homes and immediate rental-only investment properties do not meet VA occupancy rules. Full entitlement does not waive occupancy requirements. B. Exam warning. B. Misrepresenting occupancy is B. Mortgage fraud. B. Furious smiley. P. Question 7. What is the VA funding fee? Option A. A monthly mortgage insurance premium. Option B. A fee paid only by the seller. Option C. A penalty fee charged for early payoff. Option D. A one-time fee that helps fund the VA loan program. Take a moment to choose your answer. The correct answer is option D. A one-time fee that helps fund the VA loan program. Explanation. P. B. Correct. B. Answer 2. The B. VA funding fee B is generally a less than B one-time fee B charged on VA loans to help keep the program running and reduce costs to taxpayers. It often replaces the need for monthly mortgage insurance. B's key details. PEUL can usually be a B financed into the loan. B. Increasing loan balance. A amount varies based on the B to first time vs subsequent use. B. Down payment and loan type. B. Why others are wrong. B. It is not monthly MI, not seller only, and not a prepayment penalty. B. Exam clue or BEVA equals funding fee, one time, not monthly MIP. Question 8. Which statement best describes a VA loan? Option A. A loan funded directly by the Department of Veterans Affairs. Option B. A loan made by a private lender and guaranteed by the VA. Option C. A loan insured by FHA for veterans only. Option D. A conventional loan that always requires PMI. Take a moment to choose your answer. The correct answer is option B. A loan made by a private lender and guaranteed by the VA. Explanation. P. Correct. B. Answer 3. P greater than a VA loan is originated and funded by a less than B private lender. B. Bank, credit union, mortgage company. The BEVA does not lend money to B. Instead, the VA provides a less than B loan guarantee, B, that covers part of the lender's loss if the borrower defaults. B. Why this matters? B, because the lender's risk is reduced. VA loans can offer benefits like B, 0% down, B, and B, no monthly mortgage insurance. B, furious smileys. B. Why the other answers are wrong? B. Answer 1. B. VA is not a direct lender. B. Answer 2. B. PMI is tied to conventional loans. VA loans do not require monthly MI. B. Answer 4. B. FHA insures loans. VA guarantees loans for eligible service members. B. Exam clue. B. Furious smiley. VA guarantees. Lenders lend. P. Question 9. What is the typical down payment requirement for a VA loan with full entitlement? Option A, 0%, option B, 10%, option C, 3.5%, option D, 3%. Take a moment to choose your answer. The correct answer is option A, 0%. Explanation. B. Correct. B. Answer 1. VA loans commonly allow the B 100% financing, B 0% down, for borrowers with B full entitlement, B, assuming the borrower qualifies under lender underwriting standards. B. What to understand? B 0% down does not mean no qualification. The borrower must still meet credit, income, and appraisal requirements. B. Exam trap. B 3.5% down is FHA. If you see 3.5%, think FHA, not VA. B. Exam clue. B. VA purchase equals often B 0% down. B. furious smiley. P. Question 10. Which underwriting factor is strongly emphasized in VA loans compared to other programs? Option A, residual income analysis. Option B, private mortgage insurance history. Option C, a strict 28/36 debt ratio. Option D, a mandatory 20% down payment. Take a moment to choose your answer. The correct answer is option A, residual income analysis. Explanation. B. Correct. B. Answer 1. VA underwriting focuses heavily on B, the residual income, B, which is the money left over after paying housing expenses, debts, taxes, and basic living costs. B. Why VA uses this? B, the residual income is a real-world affordability measure. Two borrowers can have the same DTI but very different ability to live comfortably depending on family size, region, and expenses. B. Why others are wrong? B. VA does not require PMI, does not use a strict 28/36 rule, and does not mandate 20% down. B. Exam clue. B. VA equals B, the residual income. B. Focus. P. Question 11. What does the VA appraisal primarily evaluate? Option A, only the borrower's creditworthiness. Option B, only the neighborhood market trends. Option C, only the market value of the home. Option D, value and compliance with VA minimum property requirements. Take a moment to choose your answer. The correct answer is option D, value and compliance with VA minimum property requirements. Explanation. B. Correct. B. Answer 2. P greater than a VA appraisal evaluates B, the market value, B, and checks whether the property meets B, VA minimum property requirements, MPRs, B. MPRs ensure the property is B, safe, structurally sound, unsanitary, B. Furious smileys, P. Examples of MPR issues, PEUL, elite, unsafe electrical wiring, elite roof failure or severe water intrusion, no heat in a cold climate, elite structural instability, P. Exam contrast, B. Conventional appraisals focus mainly on value. VA, FHA also focus on minimum property standards, B. Exam clue, or B. VA appraisal equals value plus MPRs, P. Question 12. What is a major benefit of VA loans compared to FHA loans? Option A. VA loans do not require monthly mortgage insurance. Option B. VA loans require a minimum 3.5% down payment. Option C. VA loans are only for investment properties. Option D. VA loans require monthly mortgage insurance. Take a moment to choose your answer. The correct answer is option A. VA loans do not require monthly mortgage insurance. Explanation. B. Correct. B. Answer 3. VA loans do not require monthly mortgage insurance, no PMI and no FHA style MIP. This often makes the VA payment lower than FHA for the same loan amount. Important contrast, PEUL, FHA has upfront plus annual mortgage insurance, MIP. VA typically has a less than B one-time funding fee B with exemptions, but B no monthly MI furious smiley P why others are wrong. B VA does not require 3.5% down, that's FHA. VA is not for investment-only properties. B exam clue, or VA equals a B no monthly MI furious smileys P. Question 13. When is a reverse mortgage repaid? Option A. Never. Option B. After 5 years. Option C. A monthly. Option D. At borrower death or home sale. Take a moment to choose your answer. The correct answer is option D. At borrower death or home sale. Explanation. The loan is repaid when the borrower leaves the home. Question 14. In a reverse mortgage, who receives payments? Option A. A lender. Option B. Seller. Option C. A borrower. Option D. Government. Take a moment to choose your answer. The correct answer is option C. A borrower. Explanation. Borrowers receive funds from their equity. Question 15. Reverse mortgages reduce, option A. Home equity. Option B. Property taxes. Option C. Credit score. Option D. Monthly income. Take a moment to choose your answer. The correct answer is option A. Home equity. Explanation. Equity is consumed over time. Question 16. What type of reverse mortgage is most common? Option A. Proprietary. Option B. HECM. Option C. VA reverse. Option D. USDA reverse. Take a moment to choose your answer. The correct answer is option B. HECM. Explanation. HECMs are FHA-insured reverse mortgages. Question 17. Reverse mortgage interest, option A, is forgiven. Option B, Is paid monthly option C, accrues over time option D. Is cap, take a moment to choose your answer. The correct answer is option C, accrues over time explanation. Interest accrues and increases loan balance. Question 18. Reverse mortgage counseling is option A. Only for VA loans option B, required option C, prohibited option D, optional, take a moment to choose your answer. The correct answer is option B, required explanation. HUD counseling is mandatory. Question 19. Reverse mortgages require option A, a monthly payment option B, balloon payment option C. No monthly payments option D, PMI payments, take a moment to choose your answer. The correct answer is option C. No monthly payments explanation. No monthly repayment is required. Question 20. Heirs can keep the home by option A, government forgiveness option B, refinancing automatically option C, ignoring the loan option D, paying off the balance, take a moment to choose your answer. The correct answer is option D, paying off the balance explanation. Heirs may repay or sell the property. Question 1. Reverse mortgage borrowers must option A, refinance yearly option B, sell the home immediately option C, maintain property and pay taxes option D, make interest payments, take a moment to choose your answer. The correct answer is option C, maintain property and pay taxes explanation. Borrowers must meet ongoing obligations. Question 2. Who qualifies for a reverse mortgage? Option A, investors option B. First-time buyers option C. Any homeowner option D, age 62 or older, take a moment to choose your answer. The correct answer is option D, age 62 or older explanation. Borrowers must be at least 62 years old. Question 3. A reverse mortgage typically becomes due when option A, borrower opens a bank account option B, borrower refinances option C, borrower sells, dies, or no longer occupies the home option D, borrower makes the first monthly payment, take a moment to choose your answer. The correct answer is option C, borrower sells, dies, or no longer occupies the home explanation. P. Reverse loans are usually due upon B. Sales B, B. The deaths B, or B. Move out the B, and other program triggers. P. Question 4. Reverse mortgages are generally designed for borrowers who are option A, only first-time buyers option B, under age 18 option C, typically age 62 or older, program rules vary option D. Only investors, take a moment to choose your answer. The correct answer is option C, typically age 62 or older, program rules vary, explanation. P. Most reverse mortgage programs target older homeowners, commonly B 62 plus as B. P. Question 5. A refinance is best described as option A. A construction draw option B. A short-term bridge option C, replacing an existing mortgage with a new mortgage option D. A loan used only to buy a home. Take a moment to choose your answer. The correct answer is option C, replacing an existing mortgage with a new mortgage explanation. P. B. Refinance B, replaces old loan with a new one, rate, term or cash out. P. Question 6. A cash-out refinance is one where, option A, loan amount decreases and borrower gets no funds, option B, borrower receives no disclosures, option C, a loan becomes open-ended, option D, loan amount increases and borrower receives cash proceeds. Take a moment to choose your answer. The correct answer is option D, loan amount increases and borrower receives cash proceeds. Explanation. P. B. Cash out. B means borrower takes equity out, new loan is larger than old payoff. P. Question 7. A common reason for refinancing is to, option A, eliminate lien priority rules, option B, increase the interest rate, option C, lower the rate or change the term of payment, option D. Avoid owning the property. Take a moment to choose your answer. The correct answer is option C, lower the rate or change the term payment. Explanation. P. Borrowers often refinance to B. Reduce rate and B. Adjust term or access equity. P. Question 8. A purchase money mortgage is created for the purpose of, option A, financing home improvements only, option B, converting equity to cash for seniors, option C, paying property taxes only, option D, buying the property at the time of purchase. Take a moment to choose your answer. The correct answer is option D, buying the property at the time of purchase. Explanation. P. B. Purchase money B. Financing is used to acquire the home at purchase. P. Question 9. Purchase money mortgages are most associated with what timing? Option A. Only when borrower turns 62, option B. Only after foreclosure, option C. Only after 10 years of ownership, option D. At the time the borrower purchases the property. Take a moment to choose your answer. The correct answer is option D. At the time the borrower purchases the property. Explanation. P. Key point is B. Purchase timing B. Loan is tied to acquiring the property. P. Question 10. Which situation most commonly involves a purchase money mortgage concept? Option A. Seller provides financing at closing to help buyer purchase the home, option B. Borrower uses construction draws, option C. Borrower opens a HELOC years later, option D. Borrower refinances a 5-year-old loan. Take a moment to choose your answer. The correct answer is option A. Seller provides financing at closing to help buyer purchase the home. Explanation. P. A purchase money can include B. Seller financing B. provided to complete the purchase transaction. P. Question 11. Which term best matches home plus appliances finance together? Option A, package mortgage. Option B, construction loan. Option C, the budget mortgage. Option D, closed-end mortgage. Take a moment to choose your answer. The correct answer is option A, package mortgage. Explanation. P. That is the definition of A less than B, package mortgage. B. Furious smileys. P. Question 12. Package mortgages are most likely to appear in which context? Option A, manufactured housing or transactions including major personal property. Option B, bridge loans between sales. Option C, blanket liens for developers. Option D, reverse mortgage payouts. Only take a moment to choose your answer. The correct answer is option A, manufactured housing or transactions including major personal property. Explanation. P. They are common where personal property is part of the finance package. Manufactured home settings. P. Question 13. A package mortgage typically includes financing for option A, only property taxes. Option B, only construction draws. Option C, real property only. Option D, real property plus certain personal property, e.g., appliances. Take a moment to choose your answer. The correct answer is option D, real property plus certain personal property, e.g., appliances. Explanation. P. B. Package mortgage. B. Can include home plus appliances or other personal property in one loan. P. Question 14. If a borrower consistently makes only the minimum payment, the loan balance will option A, increase. Option B, be forgiven. Option C, stay the same. Option D, decrease. Take a moment to choose your answer. The correct answer is option A, increase. Explanation. P. Minimum payments may not cover full interest, resulting in balance growth. P. Question 15. Which payment option reduces principal? Option A, 30-year amortized payment. Option B, minimum payment. Option C, teaser payment. Option D, interest only. Take a moment to choose your answer. The correct answer is option A, 30-year amortized payment. Explanation. P. Only the fully amortized payment reduces principal. P. Question 16. An option loan allows a borrower to option A, convert to FHA automatically. Option B, avoid interest payments entirely. Option C, lock the interest rate permanently. Option D, choose from multiple monthly payment options. Take a moment to choose your answer. The correct answer is option D, choose from multiple monthly payment options. Explanation. P. An option ARM allows the borrower to select from multiple payment options each month. P. Question 17. The fully indexed rate of an option ARM equals option A, index plus margin. Option B, index only. Option C, margin only. Option D, teaser rate only. Take a moment to choose your answer. The correct answer is option A, index plus margin. Explanation. P. The fully indexed rate is calculated by adding the index to the margin. P. Question 18. Option arms became controversial primarily because they Option A required 50% down payments, Option B allowed loan balances to increase, Option C had no interest, Option D caused borrowers to build equity too quickly. Take a moment to choose your answer. The correct answer is Option B, allowed loan balances to increase. Explanation. P in negative amortization caused balances to grow, leading to payment shock and default risk. P. Question 19. Payment shock in an Option ARM typically occurs when Option A. The borrower refinances, Option B. The borrower sells the property, Option C. The escrow account is closed, Option D. The minimum payment period ends and the loan recasts. Take a moment to choose your answer. The correct answer is Option D. The minimum payment period ends and the loan recasts. Explanation. P. When the loan recasts after negative amortization, payments can increase significantly. P. Question 20. An Option ARM will automatically recast when Option A property taxes increase, Option B. The borrower requests refinancing, Option C. The borrower misses one payment, Option D. The loan balance reaches a negative amortization cap. Take a moment to choose your answer. The correct answer is Option D. The loan balance reaches a negative amortization cap. Explanation. P. Most option arms have a negative amortization cap, e.g., 110 to 125% of original balance, triggering recast. P. Question 1. Negative amortization occurs when Option A. The interest rate decreases, Option B. The borrower pays extra principal, Option C. The loan balance decreases, Option D. The borrower pays less than the interest due. Take a moment to choose your answer. The correct answer is Option D. The borrower pays less than the interest due. Explanation. P. If the minimum payment does not cover accrued interest, the unpaid portion is added to the principal balance. P. Question 2. After the financial crisis, option arms became rare primarily due to Option A, removal of indexes, Option B, increased teaser rates, Option C, elimination of margins, Option D, ability to repay requirements. Take a moment to choose your answer. The correct answer is Option D, ability to repay requirements. Explanation. P. The ability to repay rules limited risky features like negative amortization loans. P. Question 3. The minimum payment option in an Option ARM is typically based on Option A, prime rate plus margin, Option B, teaser rate, Option C, a fully indexed rate, Option D, fixed 30-year rate. Take a moment to choose your answer. The correct answer is Option B, teaser rate. Explanation. P. The minimum payment is often based on a low introductory teaser rate. P. Question 4. Which statement about option arms is true? Option A, payment options are chosen only after the teaser period ends. Option B, payment options are chosen only when the index changes. Option C, payment options can only be selected at closing. Option D, payment options can be selected monthly by the borrower. Take a moment to choose your answer. The correct answer is option D, payment options can be selected monthly by the borrower. Explanation. PED option arms allow borrowers to choose their payment option each month, which can create negative amortization and payment shock risks. P. Question 5. In an option ARM, the borrower typically may choose among payment options. Option A, only once at closing. Option B, each month when making the payment. Option C, only after 5 years. Option D, once per year at rate adjustment. Take a moment to choose your answer. The correct answer is option B, each month when making the payment. Explanation. PED option arms are designed to let borrowers select from multiple payment options each month. P. Question 6. A key feature that distinguishes an option ARM from a standard ARM is that it option A has no margin. Option B never adjusts the interest rate. Option C is always fixed for 30 years. Option D allows the borrower to choose different monthly payment amounts. Take a moment to choose your answer. The correct answer is option D allows the borrower to choose different monthly payment amounts. Explanation. PED and option ARM provides multiple monthly payment choices, minimum, interest only, and fully amortizing options. OP. Question 7. If a borrower selects the minimum payment option on an option ARM, they may select it. Option A, each month, subject to recast in negative amortization limits. Option B, only once per year. Option C, only after the loan is fully indexed. Option D, only during the first month. Take a moment to choose your answer. The correct answer is option A, each month, subject to recast in negative amortization limits. Explanation. P. The minimum payment can be chosen monthly, but repeated minimum payments may cause negative amortization and trigger a recast when caps are reached. P. Question 8. A loan allows the borrower to choose each month between a minimum payment, interest-only payment, and fully amortizing payments. This loan is best described as option A, fixed-rate mortgage. Option B, balloon mortgage. Option C, standard ARM. Option D, option ARM, payment option loan. Take a moment to choose your answer. The correct answer is option D, option ARM, payment option loan. Explanation. P. The defining feature of an option ARM is the borrower's ability to choose among multiple payment options each month. P. Question 9. Which product is most similar to an open-ended mortgage concept? Option A, a balloon mortgage. Option B, purchase money first mortgage. Option C, a HELOC. Option D, 30-year fixed. Take a moment to choose your answer. The correct answer is option C, a HELOC. Explanation. P. B. A HELOC. B is a common example of revolving open-ended credit secured by a home. P. Question 10. In an open-ended arrangement, the outstanding balance can, option A, never change. Option B, only decrease. Option C, disappear without repayment. Option D, increase or decrease as the borrower draws and repays. Take a moment to choose your answer. The correct answer is option D, increase or decrease as the borrower draws and repays. Explanation. P. Open-ended credit allows draws repayment so balance can move up or down. P. Question 11. An open-ended mortgage generally allows the borrower to, option A, lock the rate forever. Option B, avoid a lien entirely. Option C, pay only a balloon at the end. Option D, borrow additional funds later under the same security. Take a moment to choose your answer. The correct answer is option D, borrow additional funds later under the same security. Explanation. P. B. Open-ended. B means future advances may be secured by the same mortgage, HELOC-like concept. P. Question 12. A junior loan is best described as option A, a loan with no lien. Option B, a first lien mortgage. Option C, a loan only for construction. Option D, a subordinate lien behind the first mortgage. Take a moment to choose your answer. The correct answer is option D, a subordinate lien behind the first mortgage. Explanation. P. B. Junior lien. A B is subordinate to the first mortgage, e.g., second mortgage, HELOC. P. Question 13. A borrower takes a second mortgage after buying the home. This second mortgage is A, option A, budget mortgage. Option B, first mortgage. Option C, junior loan. Option D, construction loan. Take a moment to choose your answer. The correct answer is option C, a junior loan. Explanation. P. Second mortgages are typically B. Junior liens. B. Furious smileys. P. Question 14. Why do junior liens often carry higher rates? Option A, they cannot foreclose. Option B, they are guaranteed by HUD. Option C, they are riskier because they are paid after the first lien. Option D, they have no closing costs. Take a moment to choose your answer. The correct answer is option C, they are riskier because they are paid after the first lien. Explanation. P. Junior liens have higher loss risk because they are behind the first lien in foreclosure priority. P. Question 15. Jumbo loans typically require, option A, no documentation. Option B, higher credit scores. Option C, lower credit scores. Option D, FHA insurance. Take a moment to choose your answer. The correct answer is option B, higher credit scores. Explanation. Higher risk requires stronger borrowers. Question 16. Jumbo loans are considered, option A, government-insured. Option B, non-conforming. Option C, subsidized. Option D, conforming. Take a moment to choose your answer. The correct answer is option B, non-conforming. Explanation. They do not meet GSE guidelines. Question 17. Jumbo loans require which documentation? Option A, FHA counseling option B, full documentation option C. No income verification option D, reduced documentation. Take a moment to choose your answer. The correct answer is option B, full documentation explanation. Lenders require full financial verification. Question 18. Down payments on jumbo loans are usually option A, 0, option B, higher, option C, optional, option D, lower. Take a moment to choose your answer. The correct answer is option B, higher explanation. Lenders require more borrower equity. Question 19. Jumbo loans pose higher risk because option A, larger loan amounts, option B, short terms, option C, FHA insurance, option D, smaller balances. Take a moment to choose your answer. The correct answer is option A, larger loan amounts explanation. Higher balances increase lender exposure. Question 20. What defines a jumbo loan? Option A, adjustable rate, option B, FHA insurance, option C, loan exceeding conforming limits, option D, balloon payment. Take a moment to choose your answer. The correct answer is option C, loan exceeding conforming limits explanation. Jumbo loans exceed FHFA conforming limits. Question 1. Jumbo loans cannot be sold to option A, USDA, option B, VA, option C, FHA, option D, Fannie Mae or Freddie Mac. Take a moment to choose your answer. The correct answer is option D, Fannie Mae or Freddie Mac explanation. They exceed GSE loan limits. Question 2. Jumbo loans are funded by option A, private lenders, option B, GSEs, option C, CFPB, option D, HUD. Take a moment to choose your answer. The correct answer is option A, private lenders explanation. Private lenders fund jumbo loans. Question 3. Jumbo loans often have option A, higher rates, option B, no rates, option C, government caps, option D, lower rates. Take a moment to choose your answer. The correct answer is option A, higher rates explanation. Higher risk can lead to higher rates. Question 4. Jumbo loans are most common in option A, low-income areas, option B, USDA zones, option C, rural areas, option D, high-cost housing markets. Take a moment to choose your answer. The correct answer is option D, high-cost housing markets explanation. High home prices require jumbo financing. Question 5. A jumbo loan is typically option A, above conforming loan limits, option B, only for construction draws, option C, Only for seniors option D. Below conforming loan limits, take a moment to choose your answer. The correct answer is option A. Above conforming loan limits explanation. B jumbo B exceeds conforming limits and often requires stricter underwriting. P. Question 6. Which is most common with jumbo loans? Option A. No appraisal required. Option B. Stricter credit reserve requirements. Option C. Looser underwriting than conforming. Option D. No documentation allowed. Take a moment to choose your answer. The correct answer is option B. Stricter credit reserve requirements explanation. P jumbo loans often have B stricter, B credit, reserve, and documentation requirements. P. Question 7. Why are jumbo loans treated differently by many lenders? Option A. They have no interest rate. Option B. They are always government insured. Option C. They cannot be sold as standard conforming loans to agencies. Option D. They have no lien. Take a moment to choose your answer. The correct answer is option C. They cannot be sold as standard conforming loans to agencies. Explanation. P jumbo loans are typically B and non-conforming. B, meaning they don't fit standard agency purchase rules. P. Question 8. Which requirement commonly applies to HPMLs but not to standard conventional loans? Option A. Prohibition of prepayment penalties. Option B. Prohibition of balloon payments. Option C. Mandatory mortgage counseling. Option D. Escrow accounts for taxes and insurance. Take a moment to choose your answer. The correct answer is option D. Escrow accounts for taxes and insurance. Explanation. P. B. Correct. B. Answer 2. HPMLs typically require escrow accounts as an added consumer protection. P. Question 9. What primarily determines whether a loan is classified as a high-priced mortgage loan, HPML? Option A. The loan's points and fees only. Option B. The borrower's credit score. Option C. Whether the loan has a balloon payment. Option D. The loan's April compared to the APOR. Take a moment to choose your answer. The correct answer is option D. The loan's April compared to the APOR. Explanation. P. B. Correct. B. Answer 2. HPML classification is based on how much the loan's April exceeds the average prime offer rate, APOR. B. Exam tip. B. HPML equals rate-based trigger, P. Question 10. A first lien mortgage has an April that exceeds the average prime offer rate, APOR, by more than the HPML threshold but does not exceed HOPA points and fees limits. How is the loan classified? Option A, HPML only. Option B, HOPA only. Option C, both HPML and HOPA. Option D, neither HPML nor HOPA. Take a moment to choose your answer. The correct answer is option A, HPML only. Explanation. B. Correct. B. HPML only. P. This loan exceeds the B. April FLAPA threshold B, but not the higher B. HOPA cost thresholds of B. Furious Smileys P. B. Exam rule B. HPML triggers first. HOPA requires much higher cost levels P. Question 11. A lender mistakenly treats an HPML as a standard loan and fails to establish escrow. What is the issue? Option A, a failure to comply with HPML safeguards. Option B, HOPA violation. Option C, a RESPA escrow violation. Option D, HPA violation. Take a moment to choose your answer. The correct answer is option A, a failure to comply with HPML safeguards. Explanation. P. B. Correct. B. HPML safeguards violated. P. HPMLs generally require escrow accounts as an added consumer protection. P. Question 12. A borrower receives an HPML for a primary residence. Which additional requirement is most likely to apply? Option A, prepayment penalty ban. Option B, mandatory balloon payment. Option C, mandatory counseling. Option D, escrow account for taxes and insurance. Take a moment to choose your answer. The correct answer is option D, escrow account for taxes and insurance. Explanation. P. B. Correct. B. Escrow account. P. HPMLs generally require B. Escrow accounts. B. as an added consumer protection. P. Question 13. An HPML involves a recent property flip. What additional requirement may apply? Option A, a balloon payment prohibition. Option B, mandatory counseling. Option C, a ban on prepayment penalties. Option D, an interior appraisal requirement. Take a moment to choose your answer. The correct answer is option D, an interior appraisal requirement. Explanation. P. B. Correct. B. Interior appraisal. HPML rules include stricter appraisal requirements for certain property flips. P. Question 14. A borrower applies for a higher price mortgage. The lender fails to verify the borrower's ability to repay. Which rule is violated? Option A, RESPA Section 8. Option B, HPA. Option C, HOPA. Option D, HPML underwriting safeguards. Take a moment to choose your answer. The correct answer is option D, HPML underwriting safeguards. Explanation. P. B. Correct. B. HPML safeguards. P. HPMLs require B. the ability to repay verification. B. due to elevated risk. P. Question 15. Which factor can trigger HOPA coverage? Option A, April exceeding HOPA thresholds. Option B, borrower income level. Option C, a property location. Option D, a loan-to-value ratio. Alone. Take a moment to choose your answer. The correct answer is option A, April exceeding HOPA thresholds. Explanation. P. B. Correct. B. Answer 1. P. HOPA is triggered by April or points and fees thresholds defined under Regulation Z. P. Question 16. Which loan feature is generally prohibited under HOPA? Option A, escrow accounts. Option B, fixed interest rates. Option C, fully amortizing payments. Option D, a negative amortization. Take a moment to choose your answer. The correct answer is option D, a negative amortization. Explanation. P. B. Correct. B. Answer 2. P. HOPA prohibits negative amortization and other abusive loan features. P. Question 17. A loan exceeds HOPA April thresholds but has low points and fees. How is it treated? Option A, HPML only. Option B, HOPA applies if any trigger is met. Option C, not HOEPA. Option D, neither. Take a moment to choose your answer. The correct answer is option B, HOPA applies if any trigger is met. Explanation. B. Correct. B. HOPA applies. P. HOPA coverage can be triggered by A. B. April OR points and fees. B. Furious smileys. P. Question 18. A lender offers a HOPA-covered loan with a large balloon payment due in 3 years. Is this allowed? Option A, no, balloon payments are generally prohibited under HOPA. Option B, yes, if disclosed. Option C, yes, if borrower agrees. Option D, only allowed on refinances. Take a moment to choose your answer. The correct answer is option A. No, balloon payments are generally prohibited under HOPA. Explanation. B. Correct. B. Not allowed. P. HOPA generally. B. Prohibits balloon payments. B. With very limited exceptions. P. Question 19. A high-cost mortgage includes a negative amortization feature. Is this allowed? Option A, no, unless it is a first lien loan. Option B, no, negative amortization is prohibited under HOPA. Option C, yes, if fully disclosed. Option D, yes, if borrower income is verified. Take a moment to choose your answer. The correct answer is option B. No, negative amortization is prohibited under HOPA. Explanation. B. Correct. B. Not allowed. P. HOPA. B. Prohibits negative amortization. B. Due to its abusive nature. P. Question 20. A refinance loan includes very high points and fees and exceeds HOPA thresholds. What additional impact does HOPA have? Option A, it prohibits certain loan features. Option B, it converts the loan to an HPML. Option C, it only requires an escrow account. Option D, it removes ATR requirements. Take a moment to choose your answer. The correct answer is option A. It prohibits certain loan features. Explanation. B. Correct. B. Prohibits certain loan features. P. HOPA does not just add safeguards, it B. restricts or bans abusive features. B. like negative amortization and most balloon payments. P. Question 1. A lender provides a below-market rate but receives a percentage of future property value increase. This is most similar to Option A, growth equity participation structure. Option B, closed-end mortgage. Option C, a purchase money mortgage. Option D, a budget mortgage. Take a moment to choose your answer. The correct answer is Option A, growth equity participation structure. Explanation. P. Sharing appreciation is in the B. Equity participation. The B. Type concept. P. Question 2. A growth equity mortgage concept most closely resembles Option A, a construction draw schedule. Option B, a standard fixed-rate mortgage only. Option C, equity sharing where future appreciation is partially shared. Option D, an escrow-only budgeting feature. Take a moment to choose your answer. The correct answer is option C, equity sharing, where future appreciation is partially shared. Explanation. PE exam-wise, treat it like B equity-linked B terms, affordability now vs sharing upside later, P. Question 3. A common trade-off in equity-linked mortgages is, option A, a higher monthly payment now, option B, no lien recorded, option C, a borrower avoids underwriting, option D, lower cost now, lender shares in appreciation later. Take a moment to choose your answer. The correct answer is option D, lower cost now, lender shares in appreciation later. Explanation. P. Borrower gets lower cost now but shares a B, future gains a B. Furious smileys. P. Question 4. Some GPMs can result in negative amortization when, option A, borrower pays escrow, option B, payments exceed interest due, option C, payments are less than the interest due, option D, loan is paid off early. Take a moment to choose your answer. The correct answer is option C, payments are less than the interest due. Explanation. B. Negative amortization. B happens when payment is not enough to cover interest. Unpaid interest can be added to principal. P. Question 5. Which borrower profile best fits a GPM? Option A, borrower expects income to decrease, option B, borrower expects income to increase steadily, option C, borrower only wants a short-term bridge, option D, borrower wants no payments. Take a moment to choose your answer. The correct answer is option B, borrower expects income to increase steadily. Explanation. P. A GPM is often marketed to borrowers expecting B. a higher future income. B. Furious smileys. P. Question 6. A graduated payment mortgage, GPM, is characterized by, option A, payments that increase over time, option B, funds released in draws, option C, a final balloon payment, option D, payments that decrease each year. Take a moment to choose your answer. The correct answer is option A, payments that increase over time. Explanation. P. B. GPM B starts lower and B increases B over time, often intended for borrowers expecting rising income. P. Question 7. Which risk is minimized with a fixed-rate mortgage? Option A, interest rate risk to the borrower, option B, property tax increases, option C, title defects, option D, homeowners insurance changes. Take a moment to choose your answer. The correct answer is option A, interest rate risk to the borrower. Explanation. P. Borrower's B rate payment shock risk. B is minimized because the rate does not adjust. P. Question 8. A fixed-rate mortgage means, option A, the rate stays constant for the loan term, option B, payments always start low and increase, option C, the rate changes every year, option D, a balloon payment is required. Take a moment to choose your answer. The correct answer is option A, the rate stays constant for the loan term. Explanation. P. B fixed rate. B equals stable interest rate for the term. P. Question 9. A borrower who wants predictable principal and interest payments typically prefers Option A, a fixed-rate mortgage, Option B, ARM, Option C, construction loan, Option D, balloon mortgage. Take a moment to choose your answer. The correct answer is Option A, a fixed-rate mortgage. Explanation. B to fixed rate. B provides the most predictable P&I payments. P. Question 10. A fixed-rate mortgage is most suitable for a borrower who, Option A, plans to move in 6 months, Option B, wants long-term payment stability, Option C, wants a large balloon payment later, Option D, wants revolving credit. Take a moment to choose your answer. The correct answer is Option B, wants long-term payment stability. Explanation. P. A fixed rate is ideal for borrowers who value stable payments for many years. P. Question 11. In a fixed-rate mortgage, the interest rate, Option A, changes whenever the index changes. Option B is recalculated daily. Option C is determined by property taxes. Option D or stays the same for the entire loan term. Take a moment to choose your answer. The correct answer is Option D, stays the same for the entire loan term. Explanation. P. A fixed rate means the rate is constant throughout the term. P. Question 12. Which statement is most accurate? Option A. A fixed rate means interest only. Option B. A fixed rate guarantees taxes and insurance never change. Option C. A fixed rate eliminates escrow. Option D. A fixed rate guarantees the interest rate stays the same. Take a moment to choose your answer. The correct answer is Option D. A fixed rate guarantees the interest rate stays the same. Explanation. P. Only the B's interest rate B is fixed. Taxes, insurance can still change. P. Question 13. Compared to an ARM, a fixed-rate mortgage typically has, Option A, more payment certainty. Option B, guaranteed lower initial rate. Option C, no lien. Option D, no disclosures. Take a moment to choose your answer. The correct answer is Option A, more payment certainty. Explanation. P. A fixed rate generally offers more certainty. ARMs may start lower but can change later. P. Question 14. A borrower wants the same interest rate from the first payment through payoff. The best choice is Option A, a bridge loan. Option B, 5/1 ARM. Option C, a balloon mortgage. Option D, fixed rate mortgage. Take a moment to choose your answer. The correct answer is Option D, fixed rate mortgage. Explanation. P. The fixed rate stays constant for the entire term. P. Question 15. With a fixed-rate mortgage, the borrower is most protected from Option A, property tax increases. Option B, rising market interest rates increasing their loan rate. Option C, utility bill increases. Option D, home value changes. Take a moment to choose your answer. The correct answer is Option B, rising market interest rates increasing their loan rate. Explanation. P. Borrower's loan rate doesn't change even if market rates rise. P. Question 16. The main advantage of a fixed-rate mortgage is option A. No closing costs ever. Option B. No underwriting required. Option C. Predictable principal and interest payments. Option D. Lower initial rate than all arms. Take a moment to choose your answer. The correct answer is option C. Predictable principal and interest payments. Explanation. P. A fixed rate provides predictable payments. P&I, helping long-term budgeting. P. Question 17. A borrower has a primary loan and later takes a second mortgage. The primary loan is the option A, wraparound. Option B, junior lien. Option C, a bridge loan. Option D, first mortgage. Take a moment to choose your answer. The correct answer is option D, first mortgage. Explanation. P. The original primary loan is the B, a first mortgage. B. The later loan is the B, junior. B. Furious smileys. P. Question 18. Compared to a junior lien, a first mortgage lender usually has option A, lower risk due to priority. Option B, no right to foreclose. Option C, no right to collect interest. Option D, higher risk. Take a moment to choose your answer. The correct answer is option A, lower risk due to priority. Explanation. P. First lien priority reduces loss risk compared to subordinate liens. P. Question 19. If a lender agrees to subordinate their lien, it means option A, they move to a higher priority position. Option B, they move behind another lien in priority. Option C, they cancel the debt. Option D, they remove the lien entirely. Take a moment to choose your answer. The correct answer is option B, they move behind another lien in priority. Explanation. P. Subordination changes lien order, moving behind another lien. P. Question 20. In a foreclosure, which lien is typically paid first? Option A, first mortgage. Option B, credit card debt. Option C, unsecured creditor. Option D, junior lien. Take a moment to choose your answer. The correct answer is option A, first mortgage. Explanation. B. First mortgage. B has priority over junior liens in foreclosure proceeds. P. Question 1. The first mortgage is often called the senior lien because it, option A, requires no payment. Option B, has first claim on collateral proceeds before junior liens. Option C, is recorded last. Option D, is unsecured. Take a moment to choose your answer. The correct answer is option B, has first claim on collateral proceeds before junior liens. Explanation. P. Senior lien means highest priority claim on proceeds. P. Question 2. A first mortgage generally has which priority? Option A, no lien priority exists. Option B, paid after all other liens. Option C, automatically becomes unsecured. Option D, paid before junior liens in foreclosure. Take a moment to choose your answer. The correct answer is option D, paid before junior liens in foreclosure explanation. P. Being first lien B is typically paid before the being junior liens B in foreclosure P. Question 3. Compared to junior liens, first mortgages generally have option A, no interest rate, option B, higher interest rates because they are riskier, option C, lower interest rates because they have priority, option D, only adjustable rates. Take a moment to choose your answer. The correct answer is option C, lower interest rates because they have priority explanation. P. Lower risk due to priority often results in lower pricing compared to junior liens P. Question 4. Which statement is most accurate? Option A. A first mortgage refers to lien priority, not the borrower's first home, option B. First mortgage means interest only, option C. A first mortgage is always government insured, option D. First mortgage means open-ended. Take a moment to choose your answer. The correct answer is option A. A first mortgage refers to lien priority, not the borrower's first home explanation. P. First mortgage means a B. First lien priority at B, not a first-time buyer or first house. P. Question 5. A borrower defaults and the property is sold. After costs, proceeds go first to option A, borrower's friend who lent cash, option B. First mortgage holder, option C, credit card lender, option D. Second mortgage holder. Take a moment to choose your answer. The correct answer is option B. First mortgage holder explanation. P. Foreclosure distribution generally pays the B senior lien B first P. Question 6. A borrower has a first mortgage and then takes a HELOC. The HELOC is typically option A, a junior lien, option B, a blanket encumbrance, option C, a first lien, option D, unsecured. Take a moment to choose your answer. The correct answer is option A, a junior lien explanation. P greater than a HELOC is commonly recorded as A less than B, a second junior lien B behind the first mortgage P. Question 7. Which debt-to-income ratio guideline is typical for FHA loans? Option A, a 35/50, option B, no DTI limits apply, option C, 28/36, option D, 31/43. Take a moment to choose your answer. The correct answer is option D, 31/43 explanation. P, B, correct, B, A, answer 2. P, B, Y, B, FHA commonly uses guideline ratios of about B, 31%, B for housing expense, front end, and B, 43%, B for total debt, back end. FHA can sometimes allow higher totals with compensating factors, but the typical test answer is B, 31/43, B, furious smileys, P, B, Y. Others are wrong. B, 28/36 is a conventional guideline. 35/50 is not the standard FHA guideline, and FHA does have DTI guidance. B exam clue. B FHA standard guideline equals a B 31/43. B furious smileys P. Question 8. What is the maximum seller contribution allowed on an FHA loan? Option A 4%, option B 6%, option C 9%, option D 3%. Take a moment to choose your answer. The correct answer is option B, 6%. Explanation. P, B is correct. B, A, answer 3. P, B, Y, B, FHA permits seller concessions up to B, 6% B of the purchase price. These funds can pay for the borrower's B, closing costs, B, prepaids, B, taxes as insurance, and B, discount points, B, furious smileys, B, exam traps, B. Many conventional questions use lower limits, so 3% is a common distractor. B, exam clue, B, FHA seller concessions equals a B, 6%, B, furious smileys, P. Question 9. Which agency oversees the FHA loan program? Option A, NMLS. Option B, Federal Housing Finance Agency. Option C, U.S. Department of Housing and Urban Development. Option D, Consumer Financial Protection Bureau. Take a moment to choose your answer. The correct answer is option C, U.S. Department of Housing and Urban Development. Explanation. P, correct. B, answer 3. P, Y, B, FHA operates under the B, HUD. B, U.S. Department of Housing and Urban Development. HUD sets FHA program rules, including borrower eligibility standards and property requirements. B, Y. Others are wrong. B, FHFA. B, regulates. B, Fannie Mae and Freddie Mac. B, conventional market, not FHA. B, CFPB. B, enforces consumer protection laws but does not administer FHA. B, NMLS. B, guarantees securities backed by FHA VA USDA loans but does not set FHA eligibility rules. B, exam clue. B, if the question is who runs FHA, the answer is B, HUD. B, furious smiley. P. Question 10. What is the minimum down payment for an FHA loan with a 580 credit score? Option A 10%, option B 3.5%, option C 5%, option D 3%. Take a moment to choose your answer. The correct answer is option B, 3.5%. Explanation. P, B, correct. B, A, answer 2. P, B, Y. B, FHA standard minimum down payment is B, the 3.5%. B, when the borrower's credit score is B, 580 or higher. B. This is one of the most tested FHA facts on the SAFE exam. P, B, Y. Others are wrong. B, PEUL, B, 3%. B is more commonly associated with certain conventional programs. B, 5%. B is not the FHA rule tied to 580. B, 10%. B applies to FHA borrowers with credit scores B, 500, 579. B. Not 580 plus. UL's P, B, exam clue. B, furious smiley. 580 unlocks 3.5%. IP. Question 11. What is the FHA upfront mortgage insurance premium, UFMIP? Option A, 1.75% of the base loan amount. Option B, 2% of the purchase price. Option C, optional if credit score is high. Option D, 1% of the loan amount. Take a moment to choose your answer. The correct answer is option A, 1.75% of the base loan amount. Explanation. P, B, correct. B, answer 2. P, B, Y. B, FHA's upfront mortgage insurance premium is B, the 1.75%. B of the BT base loan amount. B. It is typically B financed, B into the loan, added to the principal, B. Why others are wrong. B. Peul. It is not 1% or 2%. It is B. Not optionals. B. Based on credit score. Ul. B. Exam clues. B. UFMIP equals B. The 1.75%. B. Furious smileys. P. Question 12. Which mortgage insurance premiums are required on FHA loans? Option A. Private mortgage insurance only. Option B. Upfront and annual mortgage insurance. Option C. Only upfront mortgage insurance. Option D. Only annual mortgage insurance. Take a moment to choose your answer. The correct answer is option B. Upfront and annual mortgage insurance. Explanation. P. B. Correct. B. Answer 3. P. Why? B. FHA requires two types of mortgage insurance. Peul. B. UFMIP. B. Upfront mortgage insurance premium, usually financed into the loan. B. Annual MIP. B. Paid monthly, commonly called MIP. P. This is different from conventional loans, which typically use B. PMI. B. Furious smileys. P. B. Exam clue. B. FHA equals B. UFMIP plus annual MIP. B. Furious smileys. P. Question 13. Which property type is eligible for FHA financing? Option A. A commercial retail building. Option B. Vacation home. Option C. 4-unit property where borrower occupies 1 unit. Option D. Investment-only rental property. Take a moment to choose your answer. The correct answer is option C. 4-unit property where borrower occupies 1 unit. Explanation. P. Correct. B. Answer 3. P. Why? B. FHA financing is for a B. Primary residences. B. FHA allows a B. The 1 for unit B. properties if the borrower occupies a B. The 1 unit B. as their main home. This supports house hacking, renting the other units, while still meeting owner occupancy rules. B. Why others are wrong. B. Investment-only properties and vacation homes do not meet FHA primary resident requirements, and commercial buildings are not eligible. B. Exam clue. B. FHA equals B. Owner-occupied primary residence. B. Furious smileys. P. Question 14. Which statement best describes the role of FHA in mortgage lending? Option A. FHA guarantees mortgage-backed securities. Option B. FHA directly lends money to qualified borrowers. Option C. FHA sets interest rates for government loans. Option D. FHA insures mortgage loans made by approved lenders. Take a moment to choose your answer. The correct answer is option D. FHA insures mortgage loans made by approved lenders. Explanation. P. Correct. B. Answer 3. P. Why? B. FHA, Federal Housing Administration. B. Does you not you lend money to borrowers? A. Less than B. A private lender. B. Bank, credit union, a mortgage company, provides the funds and originates the loan. FHA's job is to insure that loan against default, which reduces lender risk and allows more flexible down payments and credit standards. Why others are wrong. B. Answer 1. B. is incorrect because FHA is not a direct lender. B. Answer 2. B. is incorrect because B. The Jinnai Mayor B. not FHA, guarantees mortgage-backed securities. B. Answer 4. B. is incorrect because interest rates are set by lenders and market conditions. B. Exam clue or B. Remember, FHA insures, lenders lend. IP. Question 15. Which FHA refinance option allows cash out? Option A, FHA assumption. Option B, FHA streamline refinance. Option C, FHA rate and term refinance. Option D, FHA cash out refinance. Take a moment to choose your answer. The correct answer is option D, FHA cash out refinance. Explanation. B correct. B answer 3. Why? B FHA offers a less than B cash out refinance B option that allows borrowers to convert home equity into cash, subject to stricter underwriting and loan to value limits. B why others are wrong. Lead streamline refinances do not allow cash out. Lead rate and term refinances only change loan terms. Lead assumptions transfer loans, not equity. B exam clue. B only one FHA refinance allows cash, and it is named exactly that P. Question 16. Which appraisal characteristic is unique to FHA loans? Option A, no appraisal required. Option B, a market analysis only. Option C, a value only appraisal. Option D, value and minimum property standards review. Take a moment to choose your answer. The correct answer is option D, value and minimum property standards review. Explanation. B correct. B answer 3. Why? FHA appraisals are different from conventional appraisals because they evaluate both B market value, B property condition, B based on FHA minimum property standards, MPS, P. The goal is to ensure the property is B safe, sound, and secure. B furious smileys. B exam trap. B. Conventional loans focus primarily on value, not condition. P. Question 17. What happens if an FHA property does not meet minimum property standards? Option A, borrower must pay higher interest. Option B, loan is automatically denied. Option C, lender waives requirements. Option D, repairs must be completed before or at closing. Take a moment to choose your answer. The correct answer is option D, repairs must be completed before or at closing. Explanation. B correct. B answer 3. Why? B if an FHA appraisal identifies deficiencies related to safety, soundness, or security, those issues must be corrected. B before or at closing. B furious smileys. B's common issues include chipping, lead-based paint, lean roof damage, leak, unsafe electrical systems, B exam clue. Or B FHA is borrower friendly but B property strict. B furious smileys. P. Question 18. Which statement is true regarding FHA occupancy requirements? Option A, borrowers may rent out the property immediately. Option B, borrowers must occupy the home as a primary residence. Option C, occupancy is optional if down payment exceeds 20%. Option D, FHA loans are allowed for vacation homes. Take a moment to choose your answer. The correct answer is option B, borrowers must occupy the home as a primary residence. Explanation. B correct. B answer 2. Why? B FHA loans are strictly for B's owner-occupied primary residences. B. The borrower must intend to live in the property and certify this at closing. B important detail. B borrowers must typically occupy the home within B 60 days B of closing. B why others are wrong. B FHA does not allow second homes or investment-only properties regardless of down payment size. B exam warning. B misrepresenting occupancy is considered B mortgage fraud. B furious smiley. P. Question 19. Which statement is true about FHA loan assumptions? Option A. Assumptions eliminate mortgage insurance. Option B. Only VA loans are assumable. Option C. The new borrower must qualify. Option D. Assumptions require no lender approval. Take a moment to choose your answer. The correct answer is option C. The new borrower must qualify. Explanation. B. Correct. B. Answer 3. B. The Y. B. FHA loans are the B. The assumables. B. But the new borrower must meet credit and income standards and receive lender approval. B. The Y. Others are wrong. Peul. Leith assumptions are not automatic. FHA loans remain insured and keep MIP. B. Exam clues. B. The assumable does. B. Not the B. Mean unqualified. P. Question 20. What is the maximum loan-to-value allowed for an FHA cash-out refinance? Option A 75%, option B 90%, option C 80%, option D 85%. Take a moment to choose your answer. The correct answer is option C 80%. Explanation. B. Correct. B. Answer 3. B. Y. B. FHA limits cash-out refinances to a maximum of B 80% LTV. B. This ensures borrowers retain equity and reduces default risk. B. Exam contrast. B. Purchase FHA loans allow up to 96.5% LTV, but cash-out transactions are more conservative. P. Question 1. Which of the following best describes FHA debt-to-income flexibility? Option A. FHA only allows high DTI for refinances. Option B. FHA allows higher ratios with compensating factors. Option C. FHA strictly enforces a 28/36 ratio. Option D. FHA has no debt-to-income limits. Take a moment to choose your answer. The correct answer is option B. FHA allows higher ratios with compensating factors. Explanation. B. Correct. B. Answer 3. Y. B. FHA underwriting guidelines are flexible and allow higher debt-to-income ratios when B. compensating factors at B are present. These factors reduce overall risk even if DTI exceeds standard guidelines. B. Examples of compensating factors include Peul, leaf strong credit history, leaf significant cash reserves, minimal payment shock, leaf stable long-term employment, ULs, Y. Others are wrong. FHA does have DTI guidance, but it is not as strict as conventional loans. High DTI is not limited to refinances. B. Exam clue. B. FHA is flexible. I. When risk is offset. I. Furious smileys. P. Question 2. Which of the following is considered an acceptable source of FHA down payment funds? Option A. Unsecured personal loan. Option B. Gift from a family member. Option C. Borrowed funds from the seller. Option D. Cash advance from a credit card. Take a moment to choose your answer. The correct answer is option B. Gift from a family member. Explanation. B. Correct. B. Answer 3. Y. B. FHA allows the down payment and closing costs to be paid using B. Gift funds. B. From acceptable donors such as family members, employers, labor unions, or government agencies. Y. Others are wrong. Peul. Credit card advances and personal loans create additional undisclosed debt. Funds borrowed from the seller are prohibited and considered inducements. B exam clue. A BEFHA allows a BE 100% gift funds BED from approved sources. P. Question 3. In an equity participation mortgage, the lender may, option A, hold no lien on the property, option B, lose the right to collect interest, option C, only lend to seniors, option D, receive part of the property's appreciation. Take a moment to choose your answer. The correct answer is option D, receive part of the property's appreciation. Explanation. P. A lender may share in B. appreciation, B, or income, as part of the deal. P. Question 4. A loan offers a reduced rate, but the lender will receive 20% of appreciation when the home is sold. This is most likely, option A, budget mortgage, option B, closed-end mortgage, option C, a purchase money mortgage, option D, of equity participation mortgage. Take a moment to choose your answer. The correct answer is option D, equity participation mortgage. Explanation. P. Sharing appreciation equals B. Equity participation. B. Furious smileys. P. Question 5. A borrower might accept an equity participation mortgage to, option A, avoid making any disclosures, option B, pay a higher interest rate now, option C, get a lower interest rate now by giving up part of future upside, option D, turn a first lien into a junior lien. Take a moment to choose your answer. The correct answer is option C, get a lower interest rate now by giving up part of future upside. Explanation. P. Common trade. B. A lower cost now. B. In exchange for sharing. B. Future gains. B. Furious smileys. P. Question 6. A lender will receive 15% of net gain when the home is sold. This is most likely, option A, equity participation mortgage, option B, budget mortgage, option C, bridge loan, option D, closed-end mortgage. Take a moment to choose your answer. The correct answer is option A, equity participation mortgage. Explanation. P. Sharing net gain appreciation signals equity participation. P. Question 7. A borrower might accept equity participation primarily to, option A, increase monthly payments now, option B, get better affordability now, lower rate to terms, while giving up some upside, option C, avoid a lien, option D, avoid credit checks. Take a moment to choose your answer. The correct answer is option B, get better affordability now, lower rate and terms, while giving up some upside. Explanation. P. A borrower may trade future upside for lower monthly cost now. P. Question 8. Compared to a standard fixed-rate loan, an equity participation mortgage may, option A, be unsecured, option B, include lender participation in appreciation, option C, have no interest rate, option D, eliminate closing costs. Take a moment to choose your answer. The correct answer is option B, include lender participation in appreciation. Explanation. P. Equity participation adds a performance upside sharing feature. P. Question 9. Equity participation means the lender may receive, option A, only escrow funds, option B, a share of appreciation or income, option C, only principal with no interest, option D, no repayment ever. Take a moment to choose your answer. The correct answer is option B, a share of appreciation or income. Explanation. P. Equity participation often means sharing in B. Appreciation, B. or property income, P. Question 10. A lender may offer better pricing on an equity participation loan because, option A, they do not record any lien, option B, they expect to lose money, option C, they expect additional return through appreciation sharing, option D, they avoid underwriting. Take a moment to choose your answer. The correct answer is option C, they expect additional return through appreciation sharing. Explanation. P. A lender can price lower now expecting part of future upside as compensation, P. Question 11. A key borrower concern in an equity participation mortgage is, option A, automatic balloon every year, option B, not being able to record a deed, option C, having to pay taxes daily, option D, losing part of future appreciation. Take a moment to choose your answer. The correct answer is option D, losing part of future appreciation. Explanation. P. If borrower may pay less now, but sacrifices some future upside, P. Question 12. Which phrase most clearly indicates equity participation? Option A, escrow included, option B, funds released in draws, option C, one loan covers many properties, option D, share of appreciation. Take a moment to choose your answer. The correct answer is option D, share of appreciation. Explanation. P. Equity participation is identified by B. Sharing appreciation, income, B. Furious smileys, P. Question 13. During the construction period, many construction loans require, option A, a balloon payment every year, option B, no payments ever, option C, interest-only payments on the drawn amount, option D, a fixed-rate amortization from day one on full amount. Take a moment to choose your answer. The correct answer is option C, interest-only payments on the drawn amount. Explanation. P. If often borrower pays B. interest only, B. on the amount drawn, not the full approved amount, P. Question 14. Construction loans typically disburse funds through, option A, a single lump sum at closing, option B, draws based on completed work and inspections, option C, equity participation payments, option D, monthly payments from lender to borrower. Take a moment to choose your answer. The correct answer is option B, draws based on completed work and inspections. Explanation. P. B. The draw schedules B. Release funds as work is completed and verified, often via inspection. P. Question 15. Construction loans are considered higher risk because, option A, they have no collateral, option B, they are unsecured, option C, the property may not be completed on time or within budget, option D, they have no repayment plan. Take a moment to choose your answer. The correct answer is option C, The property may not be completed on time or within budget. Explanation. P. Completion and cost overrun risk makes construction lending more complex and risky. P. Question 16. A common payment structure during construction is option A. Fully amortizing payments on the full principal. Option B. Only annual balloon payments. Option C. Interest-only payments on the outstanding balance. Option D. No payments and no interest accrual. Take a moment to choose your answer. The correct answer is option C. Interest-only payments on the outstanding balance. Explanation. P. Many construction loans require interest-only payments until the project is finished. P. Question 17. Why do lenders require inspections before releasing construction draws? Option A. To confirm work completion and protect against overfunding. Option B. To increase borrower interest rate. Option C. To eliminate permits. Option D. To avoid recording the lien. Take a moment to choose your answer. The correct answer is option A. To confirm work completion and protect against overfunding. Explanation. P. Inspections confirm progress so funds match completed work and reduce fraud over advance risk. P. Question 18. During construction, interest is most often calculated on option A. The full approved loan amount from day one. Option B. Only escrow balance. Option C. Only the down payment. Option D. Only the amount drawn outstanding. Take a moment to choose your answer. The correct answer is option D. Only the amount drawn outstanding. Explanation. P. Construction loan interest is often charged on the amount actually disbursed, drawn. The P. Question 19. Which product reduces the need for a second closing after construction? Option A. Wraparound encumbrance. Option B. Budget mortgage. Option C. Construction to permanent loan. Option D. Bridge loan. Take a moment to choose your answer. The correct answer is option C. Construction to permanent loan. Explanation. P. Construction to permanent loans can convert to permanent financing, reducing extra closings. P. Question 20. A construction to permanent loan allows the borrower to, option A, eliminate lien priority rules. Option B, convert from construction financing to a permanent mortgage after completion. Option C, skip underwriting. Option D, avoid inspections entirely. Take a moment to choose your answer. The correct answer is option B, convert from construction financing to a permanent mortgage after completion. Explanation. P. This product converts to a permanent mortgage after construction is complete, subject to terms and conditions. P. Question 1. A draw schedule most commonly aligns with option A, property tax due dates. Option B, borrower credit score changes. Option C, construction milestones, foundation, framing, etc. Option D, borrower vacation dates. Take a moment to choose your answer. The correct answer is option C, construction milestones, foundation, framing, etc. Explanation. P. Draws are released as milestone work is completed. P. Question 2. Which statement best describes a construction loan? Option A replaces an existing mortgage to get a lower rate. Option B converts equity to cash for seniors. Option C bundles appliances into the loan. Option D finances building a home with disbursements in draws. Take a moment to choose your answer. The correct answer is option D, finances building a home with disbursements in draws. Explanation. P. Construction loans finance building and typically disburse funds in phases. P. Question 3. A loan has an April above APOR thresholds but does not exceed HOPA points and fees limits. How is it classified? Option A HOPA only. Option B neither HPML nor HOPA. Option C both HPML and HOPA. Option D HPML only. Take a moment to choose your answer. The correct answer is option D HPML only. Explanation. P. B. Correct. B. Answer 2. P greater than a loan can be HPML without meeting the higher thresholds required for HOPA coverage. P. Question 4. Which statement correctly compares HPML and HOPA loans? Option A, HPMLs are defined by points and fees thresholds only. Option B, HPMLs add safeguards, while HOPA loans impose strict prohibitions. Option C, both prohibit balloon payments. Option D, HOPA loans are more common than HPMLs. Take a moment to choose your answer. The correct answer is option B, HPMLs add safeguards, while HOPA loans impose strict prohibitions. Explanation. P. B. Correct. B. Answer 2. P's HPMLs focus on additional protections, while HOPA loans are heavily restricted due to their high-cost nature. P. Question 5. Which loan type is specifically designed to stop predatory lending? Option A, HPML. Option B, HOPA. Option C, QM. Option D, conventional loan. Take a moment to choose your answer. The correct answer is option B, HOPA. Explanation. P. B. Correct. B. HOPA. HOPA directly targets B. Predatory and abusive loan practices. B. Furious smileys. P. Question 6. A lender is reviewing two loans. Loan A triggers HPML rules. Loan B triggers HOPA rules. Which loan is subject to stricter limitations? Option A, Loan A. Option B, both equally. Option C, neither. Option D, Loan B. Take a moment to choose your answer. The correct answer is option D, Loan B. Explanation. P. B. Correct. B. Loan B. HOPA loans are far more restrictive than HPMLs. P. Question 7. Which loan classification is triggered solely by April exceeding APOR? Option A, subprime mortgage. Option B, qualified mortgage. Option C, HOPA. Option D, HPML. Take a moment to choose your answer. The correct answer is option D, HPML. Explanation. P. B. Correct. B. HPML. HPML classification is B. rate based only. B. Furious smileys. P. Question 8. A borrower wants to borrow additional funds using the home as collateral after closing a closed-end loan. The most likely option is Option A, automatic increase of the existing loan. Option B, refinance or take a separate junior lien. HELOC. Option C, remove the lender's lien. Option D, convert to a reverse mortgage automatically. Take a moment to choose your answer. The correct answer is Option B, refinance or take a separate junior lien. A HELOC explanation. PE closed-end loans don't re-advance. Borrower typically needs a less than B refi, B or the B second lien. HELOC. B Furia smileys P. Question 9. Which option is most clearly closed-end? Option A, 30-year fixed mortgage. Option B, revolving business line. Option C, a HELOC. Option D, credit card. Take a moment to choose your answer. The correct answer is Option A, 30-year fixed mortgage explanation. P greater than a 30-year fixed mortgage is a classic closed-end installment loan. P. Question 10. A closed-end mortgage is best described as Option A, a loan that allows repeated borrowing up to a credit limit. Option B, a one-time loan amount that cannot be increased without refinancing. Option C, a loan available only to seniors. Option D, a short-term timing loan between transactions. Take a moment to choose your answer. The correct answer is Option B, a one-time loan amount that cannot be increased without refinancing. Explanation. B closed-end. B equals fixed principal amount. Additional borrowing generally requires a new loan. A refi. P. Question 11. A closed-end mortgage is typically repaid through Option A, a revolving line with repeated draws. Option B, no payments until sale. Option C, a set repayment schedule on a fixed principal amount. Option D, construction draws only. Take a moment to choose your answer. The correct answer is Option C, a set repayment schedule on a fixed principal amount. Explanation. P or closed-end loans are set-amount installment loans repaid on a schedule. P. Question 12. Which is an example of an open-ended product, not closed-end? Option A, 30-year fixed mortgage. Option B, purchase money first mortgage. Option C, a HELOC-style revolving credit secured by home. Option D, construction to permanent loan. Take a moment to choose your answer. The correct answer is Option C, a HELOC-style revolving credit secured by home. Explanation. B open-ended. B allows reborrowing. A less than B, a HELOC. B a style product is the common example. P. Question 13. Which of the following is least likely to be closed-end? Option A, HELOC. Option B, 30-year fixed mortgage. Option C, 15-year fixed mortgage. Option D, closed-end second mortgage. Take a moment to choose your answer. The correct answer is Option A, HELOC. Explanation. P. HELOC is typically open-ended, revolving, not closed-end. P. Question 14. In a typical closed-end mortgage, the loan balance generally, Option A, never changes. Option B, can increase whenever borrower wants. Option C, increases every month. Option D, decreases over time as principal is paid. Take a moment to choose your answer. The correct answer is Option D, decreases over time as principal is paid. Explanation. P. As principal payments are made, the balance decreases unless negative amortization exists, which is not typical. P. Question 15. If a borrower wants to access additional equity after a closed-end loan closes, they usually must, option A, do nothing, the loan increases automatically. Option B, refinance or open a separate junior lien HELOC. Option C, request an automatic credit limit increase. Option D, convert it to a budget mortgage. Take a moment to choose your answer. The correct answer is option B, refinance or open a separate junior lien HELOC. Explanation. P. Closed-end loans do not re-advance, new borrowing needs a new loan HELOC. Refi. P. Question 16. A closed-end mortgage is most commonly associated with option A, unsecured lending only. Option B, installment credit secured by real property. Option C, no lien rights. Option D, revolving credit only. Take a moment to choose your answer. The correct answer is option B, installment credit secured by real property. Explanation. P. Closed-end mortgage is an installment loan secured by the home. P. Question 17. A borrower says, I can borrow more anytime on my closed-end mortgage. The best answer is option A. No, you generally need a refinance or separate loan to borrow more. Option B. Yes, it converts to HELOC automatically. Option C. Yes, just request a new draw. Option D. Yes, closed-end means open access. Take a moment to choose your answer. The correct answer is option A. No, you generally need a refinance or separate loan to borrow more. Explanation. P. Closed-end mortgages do not provide a revolving credit feature. P. Question 18. A key benefit of a budget mortgage is option A. It guarantees a lower interest rate. Option B. It helps the borrower avoid large lump sum tax insurance bills. Option C. It eliminates closing costs. Option D. It converts equity to cash. Take a moment to choose your answer. The correct answer is option B. It helps the borrower avoid large lump sum tax and insurance bills. Explanation. P. Escrowing helps borrowers budget and avoid big annual to biannual bills. P. Question 19. A budget mortgage most commonly refers to option A. A mortgage that excludes taxes and insurance. Option B. A mortgage payment that includes escrowed taxes and insurance. Option C. A mortgage used only for investment properties. Option D. A mortgage with a balloon payment. Take a moment to choose your answer. The correct answer is option B. A mortgage payment that includes escrowed taxes and insurance. Explanation. B. Budget mortgage B typically includes B escrow B, so the borrower pays a consistent monthly amount for PITI. P. Question 20. A budget mortgage payment most commonly includes option A. Only principal and interest. Option B. Principal, interest, taxes, and insurance, PITI. Option C. Only a balloon amount. Option D. Only insurance. Take a moment to choose your answer. The correct answer is option B. Principal, interest, taxes, and insurance, PITI, explanation. P. Budget mortgages commonly include B. Escrow B. for taxes and insurance as part of the monthly payment, P. Question 1. Escrow accounts can reduce lender risk by helping prevent default due to option A. Borrower choosing a fixed rate, option B. Borrower refinancing, option C. Or borrower buying appliances, option D. Unpaid property taxes leading to tax liens. Take a moment to choose your answer. The correct answer is option D. Unpaid property taxes leading to tax liens. Explanation. P. Unpaid taxes can create senior tax liens. Escrow helps keep taxes paid. P. Question 2. The primary purpose of escrow in a budget mortgage is to option A. Increase the interest rate, option B. Help ensure taxes and insurance are paid on time, option C. Avoid disclosures, option D. Eliminate the lien. Take a moment to choose your answer. The correct answer is option B. Help ensure taxes and insurance are paid on time. Explanation. P. Escrow helps manage periodic bills and reduces default risk due to unpaid taxes. Insurance. P. Question 3. Which item is least likely to be included in a typical escrow account? Option A. Property taxes, option B. Mortgage insurance, when applicable, option C. Homeowners insurance, option D. Principal balance. Take a moment to choose your answer. The correct answer is option D. Principal balance. Explanation. P. Escrow pays third-party bills like taxes, insurance, not the principal balance. P. Question 4. The escrow portion of a budget mortgage is used to pay, option A. Real estate commissions, option B. Only principal, option C. Only interest, option D. Property taxes and homeowners insurance. Take a moment to choose your answer. The correct answer is option D. Property taxes and homeowners insurance. Explanation. P. Escrow accounts commonly pay B. taxes, B. and B. insurance, B. and sometimes other items like mortgage insurance. P. Question 5. A borrower who wants stable monthly housing expense budgeting may prefer, option A. A wraparound encumbrance, option B. A balloon mortgage, option C. A budget mortgage with escrow, option D. A blanket encumbrance. Take a moment to choose your answer. The correct answer is option C. A budget mortgage with escrow. Explanation. P. Escrow-based payments can make total monthly housing cost more predictable. P. Question 6. A borrower says, "My payment is fixed because I have escrow." The best response is option A. Escrow converts the loan to an ARM, option B. Escrow eliminates interest, option C. Not necessarily. Escrow can change if taxes or insurance change, option D. Correct. Escrow never changes. Take a moment to choose your answer. The correct answer is option C. Not necessarily. Escrow can change if taxes or insurance change. Explanation. P. Escrow is helpful for budgeting, but amounts can adjust based on taxes, insurance and escrow analysis. P. Question 7. Even with a budget mortgage, the payment can change if, option A, the deed is not recorded, option B, the loan becomes unsecured, option C, the borrower gets a raise, option D, taxes or insurance premiums increase. Take a moment to choose your answer. The correct answer is option D, taxes or insurance premiums increase. Explanation. P. If escrow costs rise, the escrow portion of the payment can increase. P. Question 8. Bridge loans are most common in, option A, first-time buyers, option B, real estate transactions, option C, student loans, option D, auto loans. Take a moment to choose your answer. The correct answer is option B, real estate transactions. Explanation. They facilitate property purchases. Question 9. Bridge loan repayment usually comes from, option A, sale proceeds, option B, government subsidy, option C, a salary, option D, PMI refund. Take a moment to choose your answer. The correct answer is option A, sale proceeds. Explanation. The old home sale repays the bridge loan. Question 10. Bridge loans often require, option A, strong credit, option B, FHA counseling, option C, a USDA approval, option D, no documentation. Take a moment to choose your answer. The correct answer is option A, strong credit. Explanation. Lenders require strong borrower profiles. Question 11. What is a bridge loan? Option A, reverse mortgage, option B, government loan, option C, a permanent mortgage, option D, short-term temporary financing. Take a moment to choose your answer. The correct answer is option D, short-term temporary financing. Explanation. Bridge loans cover financing gaps. Question 12. Bridge loans are best described as, option A, temporary financing tools, option B, government loans, option C, high-risk long-term loans, option D, reverse equity loans. Take a moment to choose your answer. The correct answer is option A, temporary financing tools. Explanation. They temporarily bridge financing gaps. Question 13. Bridge loans usually have, option A, fixed long-term rates, option B, higher interest rates, option C, lower interest rates, option D, FHA insurance. Take a moment to choose your answer. The correct answer is option B, higher interest rates. Explanation. Short duration and risk increase rates. Question 14. What is a common risk of bridge loans? Option A, PMI, option B, appraisal waiver, option C, FHA limits, option D, failure to sell old property. Take a moment to choose your answer. The correct answer is option D, failure to sell old property. Explanation. If the old home doesn't sell, repayment is difficult. Question 15. Bridge loans are commonly used when, Option A. Paying property taxes. Option B. Refinancing FHA loan. Option C. Buying a new home before selling old one. Option D. Buying investment property. Take a moment to choose your answer. The correct answer is option C. Buying a new home before selling old one. Explanation. They bridge the gap between transactions. Question 16. Bridge loans are typically secured by option A. Government backing. Option B. Personal guarantee. Option C. Existing property. Option D. New property. Take a moment to choose your answer. The correct answer is option C. Existing property. Explanation. Existing home equity is often used. Question 17. Bridge loans are usually option A. A negative amortization. Option B. Fully amortized. Option C. Short-term. Option D. A long-term. Take a moment to choose your answer. The correct answer is option C. Short-term. Explanation. They are short-term by design. Question 18. Borrower buys a new home now and plans to pay off the short-term loan once the old home sells. This is most likely option A. Bridge loan. Option B. Budget mortgage. Option C. Package mortgage. Option D. Open-ended mortgage. Take a moment to choose your answer. The correct answer is option A. Bridge loan. Explanation. P. This is the classic B. A bridge loan. B. Timing use case. P. Question 19. A bridge loan is most often used to option A. Finance the down payment while waiting for an existing home to sell. Option B. Convert equity to cash for seniors. Option C. Bundle appliances into the loan. Option D. Fund construction draws over 18 months. Take a moment to choose your answer. The correct answer is option A. Finance the down payment while waiting for an existing home to sell. Explanation. P. Bridge loans help with timing gaps. Buy now, sell old home later. P. Question 20. A bridge loan is most appropriate when option A. Borrower wants negative amortization. Option B. Borrower wants a revolving credit line indefinitely. Option C. Borrower needs decades-long fixed stability. Option D. Borrower needs temporary funds until another transaction completes. Take a moment to choose your answer. The correct answer is option D. Borrower needs temporary funds until another transaction completes. Explanation. P. A bridge equals temporary solution until sale or permanent financing is in place. P. Question 1. Bridge loans often have higher rate fees because option A. They have no underwriting. Option B. They have no collateral. Option C. They are guaranteed by the government. Option D. They are short-term and riskier for lenders. Take a moment to choose your answer. The correct answer is option D. They are short-term and riskier for lenders. Explanation. P is short-term. Higher risk lending commonly carries higher pricing. P. Question 2. Which statement about bridge loans is most accurate? Option A. They always include a balloon payment by law option B. They usually have lower rates than permanent mortgages option C. They are only for FHA borrowers option D. They are short-term and often carry higher rates. Fees. Take a moment to choose your answer. The correct answer is option D. They are short-term and often carry higher rates. Fees. Explanation. P. Because they are short-term and riskier, bridge loans often have a B higher rate. Fees. B. Furious smileys. P. Question 3. Which statement best distinguishes a bridge loan from a construction loan? Option A. Bridge loans are only for seniors. Option B. Construction loans have no lien. Option C. Bridge loans fund building materials in draws. Option D. Bridge loans cover timing gaps. Construction loans fund building withdrawal schedules. Take a moment to choose your answer. The correct answer is option D. Bridge loans cover timing gaps. Construction loans fund building withdrawal schedules. Explanation. P. Bridge equals timing, construction equals building draws, inspections. P. Question 4. Bridge loan collateral is most commonly, option A. No collateral is required. Option B. Old property, new property, or both depending on lender. Option C. Only the old property. Option D. Only the new property. Take a moment to choose your answer. The correct answer is option B. Old property, new property, or both depending on lender. Explanation. P. Some bridge loans are secured by the existing home, the new home, or both. P. Question 5. A bridge loan is typically used when a borrower, option A, needs short-term financing while waiting to sell an existing home. Option B, wants a permanent fixed rate for 30 years. Option C, wants to avoid any lien priority issues. Option D, needs funds only released after inspections. Take a moment to choose your answer. The correct answer is option A, needs short-term financing while waiting to sell an existing home. Explanation. B. Bridge loans B are short-term and often used to buy a new home before selling the old one. P. Question 6. A lender evaluating a bridge loan will most focus on, option A, a borrower's favorite bank. Option B, whether escrow is waived. Option C, borrower's age only. Option D, borrower's exit strategy, sale, refinance, to repay the bridge loan. Take a moment to choose your answer. The correct answer is option D, borrower's exit strategy, sale, refinance, to repay the bridge loan. Explanation. P. Because it is short-term, repayment depends on an B exit strategy. B. Furious smileys. P. Question 7. If a blanket mortgage has no release clause, selling one property may, option A, be easier because the lien auto-releases. Option B, convert the loan to fixed rate automatically. Option C, require no lender involvement. Option D, require full payoff or lender approval to release the lien on that property. Take a moment to choose your answer. The correct answer is option D, require full payoff or lender approval to release the lien on that property. Explanation. P. Without a release clause, the lender may require payoff approval to remove that property from the lien. P. Question 8. A blanket encumbrance is a lien that, option A, covers multiple properties under one mortgage. Option B, Only applies to reverse mortgages. Option C covers only personal property. Option D cannot be recorded. Take a moment to choose your answer. The correct answer is option A, covers multiple properties under one mortgage. Explanation. B. A blanket. B equals one lien securing a loan across B a multiple properties. B furious smileys. P. Question 9. Blanket mortgages are most commonly used by option A, borrowers purchasing a single condo. Option B, seniors converting equity to cash. Option C, borrowers seeking escrow budgeting. Option D, developers financing multiple lots or units. Take a moment to choose your answer. The correct answer is option D, developers financing multiple lots or units. Explanation. P. Developers. Investors often finance multiple properties with a less than B. A blanket lien. B. furious smileys. P. Question 10. Which is a potential drawback for a borrower with a blanket encumbrance? Option A. The lien is automatically removed monthly. Option B. Default could affect multiple properties secured by the same lien. Option C. Borrower can never sell any property. Option D. The borrower pays no interest. Take a moment to choose your answer. The correct answer is option B. Default could affect multiple properties secured by the same lien. Explanation. P. If the borrower defaults, the lender's security interest may extend across B. all properties B. under the blanket lien. P. Question 11. Which borrower is most likely to request a blanket encumbrance? Option A, retiree using a reverse mortgage. Option B, borrower refinancing a single condo. Option C, a property developer holding multiple lots. Option D, first-time homebuyer. Take a moment to choose your answer. The correct answer is option C, property developer holding multiple lots. Explanation. P. Blanket mortgages are common for B. to developers, investors. B. with multiple properties. P. Question 12. An investor wants one loan secured by 5 rental properties. The best match is option A, reverse mortgage. Option B, budget mortgage. Option C, a blanket encumbrance. Option D, construction loan. Take a moment to choose your answer. The correct answer is option C, a blanket encumbrance. Explanation. P. The one loan secured by multiple properties describes a less than B. A blanket mortgage. B. furious smileys. P. Question 13. Which phrase most clearly signals a blanket encumbrance? Option A, interest-only withdrawals. Option B, no lien recorded. Option C, one property, many borrowers. Option D, one loan, many properties. Take a moment to choose your answer. The correct answer is option D, one loan, many properties. Explanation. P. A blanket encumbrance equals B. The one loan secured by multiple properties. B. furious smileys. P. Question 14. A release clause is important in a blanket mortgage because it, option A, allows rate changes without notice. Option B, eliminates the need for appraisals. Option C, allows individual property release when conditions are met. Option D, turns the loan into an ARM. Take a moment to choose your answer. The correct answer is option C, allows individual property release when conditions are met. Explanation. P. Release clauses allow selling one property and releasing it from the blanket lien, often by paying a set amount, P. Question 15. A release clause in a blanket mortgage allows, option A, one property to be released from the lien when conditions are met, option B, the loan to become a reverse mortgage, option C, the lender to raise the interest rate at will, option D, the borrower to stop paying taxes. Take a moment to choose your answer. The correct answer is option A, one property to be released from the lien when conditions are met. Explanation. P greater than A less than B. Release clause B lets the borrower free a specific property from the blanket lien after paying an agreed amount, P. Question 16. A blanket mortgage is most commonly used to, option A, secure one loan with multiple properties, option B, finance a single-family primary residence only, option C, convert home equity to cash for seniors, option D, replace an existing loan with a new one. Take a moment to choose your answer. The correct answer is option A, secure one loan with multiple properties. Explanation. B blanket B a lien secure a single loan with B multiple properties. B, often in development investment, P. Question 17. Are balloon loans qualified mortgages? Option A. Never, option B. Always, option C. Only FHA loans, option D. Only if they meet QM rules. Take a moment to choose your answer. The correct answer is option D. Only if they meet QM rules. Explanation. Some balloon loans can qualify under QM rules. Question 18. Balloon mortgages are most common in, option A, VA lending, option B, USDA lending, option C, commercial lending, option D, FHA lending. Take a moment to choose your answer. The correct answer is option C, commercial lending. Explanation. They are common in commercial and short-term lending. Question 19. What defines a balloon mortgage? Option A, government-backed loan, option B, large final lump sum payment, option C, a fixed rate for life, option D, adjustable rate. Take a moment to choose your answer. The correct answer is option B, large final lump sum payment. Explanation. Balloon loans require a large payment at maturity. Question 20. Balloon loans are best for borrowers who, option A, want long-term certainty, option B, expect to refinance or sell early, option C, want FHA insurance, option D, have low income. Take a moment to choose your answer. The correct answer is option B, expect to refinance or sell early. Explanation. Short-term plans reduce balloon risk. Question 1. Why are balloon mortgages risky? Option A, rate changes monthly, option B, high PMI, option C, final payment may be unaffordable, option D, no equity builds. Take a moment to choose your answer. The correct answer is option C. Final payment may be unaffordable. Explanation. Borrowers must pay or refinance the balloon amount. Question 2. Balloon payments usually occur, option A, at loan maturity, option B, during grace period, option C, are monthly, option D, every 5 years. Take a moment to choose your answer. The correct answer is option A, at loan maturity. Explanation. The balloon is due at the end of the term. Question 3. Balloon mortgages are typically, option A, partially amortized, option B, negative amortization, option C, fully amortized, option D, interest only forever. Take a moment to choose your answer. The correct answer is option A, partially amortized. Explanation. Payments do not fully amortize the loan. Question 4. What happens if borrower cannot pay balloon? Option A, rate freezes, option B, loan forgiven, option C, foreclosure risk, option D, government pays. Take a moment to choose your answer. The correct answer is option C, foreclosure risk. Explanation. Failure to pay may result in default. Question 5. Balloon loans require careful borrower counseling because, option A, no disclosures, option B, high PMI, option C, they are illegal, option D, large final payment risk. Take a moment to choose your answer. The correct answer is option D, large final payment risk. Explanation. Borrowers must understand the balloon obligation. Question 6. A borrower choosing a balloon mortgage should most carefully consider, option A, how to skip disclosures, option B, how to pay the balloon amount, refinance, sell, cash, option C, how to avoid a credit report, option D, how to remove the lien without repayment. Take a moment to choose your answer. The correct answer is option B, how to pay the balloon amount, refinance, sell, cash. Explanation. PE key is having a realistic plan to handle the B balloon payment. B furious smileys. P. Question 7. A borrower has payments based on a 30-year amortization schedule, but the loan is due in 7 years. This is most likely, option A, a reverse mortgage, option B, a balloon mortgage, option C, a construction loan, option D, an open-ended mortgage. Take a moment to choose your answer. The correct answer is option B, a balloon mortgage. Explanation. P-year payments may look like a 30-year loan, but A less than B-year balloon maturity. O B requires payoff earlier. P. Question 8. Which statement is true? Option A, a balloon mortgage has no maturity date. Option B, a balloon mortgage can have fixed or adjustable rate terms. Option C, a balloon mortgage must always have a variable rate. Option D, a balloon mortgage is unsecured. Take a moment to choose your answer. The correct answer is option B, a balloon mortgage can have fixed or adjustable rate terms. Explanation. P. Balloon refers to the B payment structure OB, big payoff at end, not necessarily the rate type, P. Question 9. A balloon mortgage differs from a fully amortizing mortgage because it, option A, requires a large remaining balance to be paid at the end, option B, has no lien recorded, option C, always has an adjustable rate, option D, pays off the entire balance through equal payments. Take a moment to choose your answer. The correct answer is option A, requires a large remaining balance to be paid at the end. Explanation. P. Balloon loans often do not fully amortize, leaving A less than B a large balance due to B at maturity of P. Question 10. Which payment pattern most suggests a balloon mortgage? Option A, payments are stable, then a large lump sum is due. Option B, payments rise gradually each year. Option C, no payments ever. Option D, payments are just monthly from day one. Take a moment to choose your answer. The correct answer is option A, payments are stable, then a large lump sum is due. Explanation. P. Stable periodic payments with a large final payoff is the typical balloon structure, P. Question 11. A borrower has low monthly payments for 7 years and then must pay the remaining balance in full. This is most likely A, option A, a balloon mortgage, option B, reverse mortgage, option C, construction loan, option D, budget mortgage. Take a moment to choose your answer. The correct answer is option A, a balloon mortgage. Explanation. P. Low payments plus remaining balance due at the end describes A less than B, balloon mortgage. B. Furious smileys. P. Question 12. What is the defining feature of a balloon mortgage? Option A, rate is fixed for the entire term. Option B, a large lump sum payment is due at the end. Option C, funds are released in construction draws. Option D, payments increase gradually each year. Take a moment to choose your answer. The correct answer is option B, a large lump sum payment is due at the end. Explanation. P greater than A less than B, a balloon B loan has a large B final payment B due at maturity. P. Question 13. Why are balloon mortgages considered risky for many borrowers? Option A, they are always illegal under federal law. Option B, borrower may be unable to refinance or pay the balloon when due. Option C, they cannot be used for primary residences. Option D, they require PMI in all cases. Take a moment to choose your answer. The correct answer is option B, borrower may be unable to refinance or pay the balloon when due. Explanation. P. Main risk, B. Refinancing risk, B. If credit, rates, or home value changes, borrower may not qualify later. P. Question 14. The main borrower risk in a balloon mortgage is, option A, taxes are never escrowed. Option B, the loan automatically becomes a reverse mortgage. Option C, the lender must forgive the balance. Option D, the borrower may not qualify to refinance at maturity. Take a moment to choose your answer. The correct answer is option D, the borrower may not qualify to refinance at maturity. Explanation. P. Balloon loans can create B. Refinance risk, B. If credit, income, or rates change. P. Question 15. Balloon mortgages are most commonly suitable for borrowers who, option A, need construction draws only, option B, want an open-ended credit line, option C, have a clear exit strategy, sell, refinance, before maturity, option D, expect to stay long-term and want maximum stability. Take a moment to choose your answer. The correct answer is option C. Have a clear exit strategy, sell, refinance, before maturity. Explanation. P. Borrowers should have a reliable B. exit strategy B. before the balloon comes due. P. Question 16. What index is commonly used for ARMs? Option A, FHA rate, option B, CPI, option C, HUD index, option D, SOFR. Take a moment to choose your answer. The correct answer is option D, SOFR. Explanation. Modern ARMs often use SOFR as the index. Question 17. Which disclosure is critical for ARMs? Option A, ARM disclosure, option B, HUD-1, option C, appraisal report, option D, loan estimate. Take a moment to choose your answer. The correct answer is option A, ARM disclosure. Explanation. ARM disclosures explain rate adjustments and caps. Question 18. What does a 5-1 ARM mean? Option A, loan term is 5 years, option B, rate fixed for 5 years then adjusts annually, option C, rate fixed for 1 year, option D, rate adjusts every 5 months. Take a moment to choose your answer. The correct answer is option B, rate fixed for 5 years then adjusts annually. Explanation. The rate is fixed for 5 years, then adjusts every year. Question 19. Who benefits most from an ARM? Option A, borrowers planning to move soon, option B, long-term homeowners, option C, retirees, option D, investors avoiding risk. Take a moment to choose your answer. The correct answer is option A, borrowers planning to move soon. Explanation. Short-term borrowers benefit most from lower initial rates. Question 20. What is an adjustable rate mortgage, ARM? Option A, a loan requiring a balloon payment, option B, a mortgage with a fixed rate for the entire term, option C, a seller-financed loan, option D, a mortgage with an interest rate that changes over time. Take a moment to choose your answer. The correct answer is option D, a mortgage with an interest rate that changes over time. Explanation. ARMs have interest rates that adjust periodically based on an index. Question 1. What does the margin represent in an ARM? Option A, a lender profit added to the index, option B, closing fee, option C, a PMI cost, option D, a borrower down payment. Take a moment to choose your answer. The correct answer is option A, a lender profit added to the index. Explanation. The margin is added to the index to calculate the ARM rate. Question 2. Why do borrowers often choose ARMs initially? Option A, lower upfront closing costs. Option B, no qualification requirements. Option C, lower initial interest rates. Option D, a guaranteed refinancing. Take a moment to choose your answer. The correct answer is option C, lower initial interest rates. Explanation. ARMs usually start with lower introductory rates than fixed-rate loans. Question 3. What is the primary risk of an ARM? Option A, property depreciation. Option B, interest rate increases. Option C, loss of equity. Option D, balloon payment. Take a moment to choose your answer. The correct answer is option B, interest rate increases. Explanation. ARM payments can increase when interest rates rise. Question 4. What is an interest rate cap? Option A, limit on rate increases. Option B, maximum loan amount. Option C, prepayment penalty. Option D, fixed rate period. Take a moment to choose your answer. The correct answer is option A, a limit on rate increases. Explanation. Caps limit how much the interest rate can increase. Question 5. Payment shock is most likely to occur when, option A, the borrower makes extra principal payments. Option B, the ARM adjusts upward due to index increases. Option C, the borrower opens a checking account. Option D, the lender collects escrow. Take a moment to choose your answer. The correct answer is option B, the ARM adjusts upward due to index increases. Explanation. B, a payment shock. B, happens when the rate resets higher and the monthly payment increases significantly. P. Question 6. Which feature is most associated with an adjustable rate mortgage, ARM, after the initial fixed period? Option A, borrower must pay a balloon payment at maturity. Option B, loan is only available for construction draws. Option C, interest rate can change based on an index plus margin. Option D, interest rate stays the same for the entire term. Take a moment to choose your answer. The correct answer is option C, interest rate can change based on an index plus margin. Explanation. B, the ARM rates B adjust based on an B index plus margin a B, subject to B rate caps B. This can change the payment after the fixed period, P. Question 7. An ARM may be appropriate for a borrower who, option A, cannot tolerate any payment change. Option B, only wants escrow for taxes. Option C, wants maximum long-term payment certainty for 30 years. Option D, plans to move or refinance before the adjustment period begins. Take a moment to choose your answer. The correct answer is option D, plans to move or refinance before the adjustment period begins. Explanation. ARMs can fit borrowers with shorter expected ownership who benefit from the lower intro rate, P. Question 8. In an ARM, the margin is best described as option A, a cap that limits rate changes. Option B, the variable market index value. Option C, the escrow amount for taxes and insurance. Option D, a fixed amount added to the index to set the fully indexed rate. Take a moment to choose your answer. The correct answer is option D, a fixed amount added to the index to set the fully indexed rate. Explanation. P. B. Margin B is the lender's fixed add-on to the B index B. Fully indexed rate equals index plus margin P. Question 9. A borrower chooses a 5/1 ARM mainly because, option A, it is only for jumbo loan amounts, option B, the initial rate is typically lower than fixed-rate loans, option C, the rate cannot change for the entire 30 years, option D, it always has negative amortization. Take a moment to choose your answer. The correct answer is option B. The initial rate is typically lower than fixed-rate loans. Explanation. P. Many borrowers choose a less than B 5/1 ARM of B to get a less than B lower initial rate B. The trade-off is possible B payment shock B later P. Question 10. Rate caps on an ARM primarily protect the borrower by, option A, eliminating escrow requirements, option B, limiting how much the rate can increase at each adjustment and over the life of the loan, option C, preventing any change in interest rate, option D, guaranteeing the lowest market rate. Take a moment to choose your answer. The correct answer is option B, limiting how much the rate can increase at each adjustment and over the life of the loan. Explanation. P. B caps B a limit increases per adjustment and or over the loan's life, reducing extreme payment jumps. P. Question 11. The interest rate on an ARM is commonly tied to, option A, only the lender's profit goal, option B, the borrower's age, option C, a market index, like SOFR, plus a margin, option D, the appraised value only. Take a moment to choose your answer. The correct answer is option C, a market index, like SOFR, plus a margin. Explanation. P. ARMs adjust using an B index B plus B margin B, subject to caps P. Question 12. A 5/1 ARM typically means, option A, adjusts every 5 years for 1 year, option B, fixed for 5 years, then adjusts every year, option C, fixed for 1 year, then adjusts for 5 years, option D, fixed for 5 months, then adjusts monthly. Take a moment to choose your answer. The correct answer is option B, fixed for 5 years, then adjusts every year. Explanation. P. B 5/1 B equals initial fixed period of 5 years, then adjusts annually. P. Question 13. Which cap limits how much an ARM can increase at the first adjustment? Option A, a periodic cap, option B, escrow cap, option C, initial adjustment cap, option D, a lifetime cap. Take a moment to choose your answer. The correct answer is option C, initial adjustment cap. Explanation. P. B initial adjustment cap B limits the first reset increase. Periodic equals later resets, lifetime equals max overall. P. Question 14. Which statement is true about ARMs? Option A, ARMs may have caps that limit increases. Option B, ARMs always have higher initial rates than fixed loans. Option C, ARMs can never have rate caps. Option D, ARMs are only for construction loans. Take a moment to choose your answer. The correct answer is option A, ARMs may have caps that limit increases. Explanation. P. Arms often include B. Caps, B. To limit how much the rate can increase at reset intervals and over the life of the loan, P. Question 15. Which feature distinguishes a hybrid ARM from a standard ARM? Option A, presence of a margin. Option B, use of an index. Option C, a periodic adjustments. Option D, initial fixed rate period. Take a moment to choose your answer. The correct answer is option D, initial fixed rate period. Explanation. P greater than a hybrid ARM has a fixed introductory period before adjustments begin, P. Question 16. A 1-1 ARM is best classified as Option A, interest-only ARM. Option B, hybrid ARM. Option C, reverse ARM. Option D, a standard ARM. Take a moment to choose your answer. The correct answer is option D, a standard ARM. Explanation. P greater than a 1-1 ARM adjusts after 1 year and continues adjusting annually, making it a standard ARM. P. Question 17. A mortgage that adjusts 1 year after origination and continues adjusting annually for the life of the loan is known as a Option A, a hybrid ARM. Option B, balloon mortgage. Option C, standard ARM. Option D, a fixed-rate mortgage. Take a moment to choose your answer. The correct answer is option C, standard ARM. Explanation. P greater than a standard ARM adjusts shortly after origination and continues adjusting regularly, P. Question 18. Loan-to-value (LTV) ratio compares, Option A, assets to liabilities. Option B, loan amount to purchase price or appraised value. Option C, income to debt. Option D, payment to income. Take a moment to choose your answer. The correct answer is option B, loan amount to purchase price or appraised value. Explanation. LTV measures loan amount against value. Question 19. Debt to income (DTI) ratio measures, Option A, assets versus liabilities. Option B, interest rate risk. Option C, a loan balance versus value. Option D, the monthly debt obligations relative to income. Take a moment to choose your answer. The correct answer is option D, monthly debt obligations relative to income. Explanation. DTI evaluates repayment capacity. Question 20. The back-end ratio includes, Option A, assets. Option B, housing expenses only. Option C, reserves only. Option D, all monthly debt obligations. Take a moment to choose your answer. The correct answer is Option D, all monthly debt obligations. Explanation. Back-end ratio includes all debts. Question 1. The front-end ratio considers, Option A, total monthly debt. Option B, housing expenses relative to income. Option C, credit score. Option D, a loan balance. Take a moment to choose your answer. The correct answer is Option B, housing expenses relative to income. Explanation. Front-end ratio focuses on housing costs. Question 2. Subprime loans are designed for borrowers with Option A, government eligibility, Option B, excellent credit, Option C, below average credit, Option D, high income. Take a moment to choose your answer. The correct answer is Option C, below average credit. Explanation. Subprime loans serve higher risk borrowers. Question 3. Combined loan-to-value, CLTV, includes Option A. Only first mortgage, Option B. All liens on the property, Option C. Our closing costs, Option D. Only purchase price. Take a moment to choose your answer. The correct answer is Option B. All liens on the property. Explanation. CLTV includes all liens. Question 4. Alt-A loans generally feature Option A. No underwriting, Option B, government insurance, Option C, a full documentation, Option D, a limited documentation or higher risk features. Take a moment to choose your answer. The correct answer is Option D, limited documentation or higher risk features. Explanation. Alt-A loans carry moderate risk. Question 5. MLOs must clearly disclose Option A, material loan features and risks, Option B. Only interest rate, Option C. Only monthly payment, Option D, lender compensation. Take a moment to choose your answer. The correct answer is Option A, material loan features and risks. Explanation. Material features and risks must be disclosed. Question 6. A balloon mortgage typically features Option A. No interest, Option B. A large payment due at the end of the term, Option C. A fully amortizing payments, Option D. A negative amortization only. Take a moment to choose your answer. The correct answer is Option B. A large payment due at the end of the term. Explanation. Balloon loans require a large final payment. Question 7. Negative amortization occurs when Option A, payments are insufficient to cover interest, Option B, interest rates decrease, Option C, a loan balance decreases faster, Option D, payments exceed interest due. Take a moment to choose your answer. The correct answer is Option A, payments are insufficient to cover interest. Explanation. Negative amortization increases the loan balance. Question 8. An ARM index is used to Option A, determine future interest rate changes, Option B, determine borrower eligibility, Option C, calculate loan amount, Option D, set closing costs. Take a moment to choose your answer. The correct answer is Option A, determine future interest rate changes. Explanation. Indexes determine ARM rate adjustments. Question 9. VA loans are guaranteed by Option A, HUD, Option B, FHA, Option C, a Department of Veterans Affairs, Option D, USDA. Take a moment to choose your answer. The correct answer is option C, Department of Veterans Affairs explanation. VA loans are guaranteed by the VA. Question 10. An adjustable rate mortgage, ARM, features, option A, interest rates that adjust based on an index, option B. No initial fixed period, option C. A fixed interest rate for the entire term, option D. No caps on rate increases. Take a moment to choose your answer. The correct answer is option A, interest rates that adjust based on an index. Explanation. ARMs adjust based on a specified index. Question 11. A conforming loan is one that, option A, conforms to Fannie Mae and Freddie Mac guidelines, option B, conforms to FHA guidelines, option C. Is insured by the government, option D. Is only for low-income borrowers. Take a moment to choose your answer. The correct answer is option A, conforms to Fannie Mae and Freddie Mac guidelines. Explanation. Conforming loans meet Fannie Mae and Freddie Mac standards. Question 12. Rate caps on ARMs limit, option A, closing costs, option B. How much the interest rate can change, option C, monthly payments only, option D, loan amount. Take a moment to choose your answer. The correct answer is option B. How much the interest rate can change. Explanation. Caps limit interest rate increases. Question 13. A home equity loan is typically, option A, a closed-end loan secured by home equity, option B, unsecured, option C. A revolving line of credit, option D, interest only. Take a moment to choose your answer. The correct answer is option A, a closed-end loan secured by home equity. Explanation. Home equity loans are closed-end, second lien loans. Question 14. FHA loans require, option A, upfront and annual mortgage insurance premiums, option B. No insurance, option C, private mortgage insurance, option D, lender-paid insurance only. Take a moment to choose your answer. The correct answer is option A, upfront and annual mortgage insurance premiums. Explanation. FHA loans require both upfront and annual MIP. Question 15. A conventional loan is best defined as a loan that, option A, is insured by FHA, option B, is guaranteed by VA, option C, is only for first-time buyers, option D, is not insured or guaranteed by a government agency. Take a moment to choose your answer. The correct answer is option D, is not insured or guaranteed by a government agency. Explanation. Conventional loans are not backed by government agencies. Question 16. Payment caps on an ARM limit, option A, loan balance, option B, interest rate changes, option C, monthly payment increases, option D, index movement. Take a moment to choose your answer. The correct answer is option C, monthly payment increases. Explanation. Payment caps limit payment increases. Question 17. USDA loans typically require Option A, high-income borrowers. Option B, self-employed borrowers only. Option C, no income limits. Option D, income within program limits. Take a moment to choose your answer. The correct answer is Option D, income within program limits. Explanation. USDA programs impose income limits. Question 18. A non-conforming loan is typically Option A, above conforming loan limits or outside agency guidelines. Option B, below conforming loan limits. Option C, government insured. Option D, restricted to owner-occupied homes. Take a moment to choose your answer. The correct answer is Option A, above conforming loan limits or outside agency guidelines. Explanation. Non-conforming loans do not meet agency guidelines. Question 19. A HELOC is best described as Option A, a balloon loan. Option B, a revolving line of credit secured by home equity. Option C, a fixed-rate installment loan. Option D, an unsecured loan. Take a moment to choose your answer. The correct answer is Option B, a revolving line of credit secured by home equity. Explanation. HELOCs are revolving credit lines secured by equity. Question 20. A fixed-rate mortgage is characterized by Option A, constant interest rate over the loan term. Option B, changing interest rates. Option C, a negative amortization. Option D, a balloon payments. Take a moment to choose your answer. The correct answer is Option A, constant interest rate over the loan term. Explanation. Fixed-rate loans maintain the same interest rate. Question 1. A permanent buy-down results in Option A, lower payments for a limited time. Option B, higher closing costs only. Option C, a variable rate. Option D, a reduced interest rate for the loan term. Take a moment to choose your answer. The correct answer is Option D, a reduced interest rate for the loan term. Explanation. Permanent buy-downs lower the rate for the entire loan. Question 2. VA loan eligibility is based on Option A, a military service requirement. Option B, income only. Option C, credit score only. Option D, first-time buyer status. Take a moment to choose your answer. The correct answer is Option A, a military service requirement. Explanation. VA eligibility is determined by military service. Question 3. A graduated payment mortgage is characterized by Option A, fixed high payments. Option B, payments that increase over time. Option C, balloon payments. Option D, decreasing payments. Take a moment to choose your answer. The correct answer is Option B, payments that increase over time. Explanation. Payments gradually increase in a graduated payment mortgage. Question 4. FHA loans are insured by Option A, Federal Housing Administration, Option B, USDA, Option C, Department of Veterans Affairs, Option D, Fannie Mae. Take a moment to choose your answer. The correct answer is Option A, Federal Housing Administration. Explanation. FHA loans are insured by the Federal Housing Administration. Question 5. An interest-only loan allows the borrower to Option A, pay principal only, Option B, avoid interest charges, Option C, skip payments entirely, Option D, pay only interest for a specified period. Take a moment to choose your answer. The correct answer is Option D, pay only interest for a specified period. Explanation. Interest-only loans delay principal repayment. Question 6. When recommending a loan product, an MLO should consider Option A, commission potential, Option B, marketing trends, Option C, lender incentives, Option D, borrower's needs, goals, and financial situation. Take a moment to choose your answer. The correct answer is Option D, borrower's needs, goals, and financial situation. Explanation. Loan suitability is based on borrower needs. Question 7. A jumbo loan is a loan that, Option A, exceeds conforming loan limits, Option B, has lower interest rates, Option C, is insured by FHA, Option D, requires no down payment. Take a moment to choose your answer. The correct answer is Option A, exceeds conforming loan limits. Explanation. Jumbo loans exceed conforming loan limits. Question 8. To qualify for a reverse mortgage, the borrower must generally be at least Option A, 62 years old, Option B, 55 years old, Option C, 60 years old, Option D, 65 years old. Take a moment to choose your answer. The correct answer is Option A, 62 years old. Explanation. Borrowers must be 62 or older. Question 9. A purchase loan is used to Option A, access home equity, Option B, pay off consumer debt, Option C, acquire a property, Option D, refinance an existing mortgage. Take a moment to choose your answer. The correct answer is Option C, acquire a property. Explanation. Purchase loans finance the acquisition of property. Question 10. A non-QM loan is Option A, a government-insured loan, Option B, a loan that does not meet qualified mortgage standards, Option C, a subprime loan only, Option D, illegal. Take a moment to choose your answer. The correct answer is Option B, a loan that does not meet qualified mortgage standards. Explanation. Non-QM loans fall outside QM standards but may still be legal. Question 11. A key benefit of FHA loans is Option A, no mortgage insurance, Option B, lower down payment requirements, Option C, no appraisal requirement, Option D, higher credit score requirements. Take a moment to choose your answer. The correct answer is Option B, lower down payment requirements. Explanation. FHA loans allow lower down payments. Question 12. The margin on an ARM is option A. The down payment amount option B. Variable over time option C. Added to the index to calculate the interest rate option D. A type of fee. Take a moment to choose your answer. The correct answer is option C. Added to the index to calculate the interest rate. Explanation. The margin is added to the index to determine the rate. Question 13. A reverse mortgage allows borrowers to, option A, convert home equity into cash without monthly payments, option B, make monthly mortgage payments, option C, purchase investment properties, option D. Avoid interest charges. Take a moment to choose your answer. The correct answer is option A, convert home equity into cash without monthly payments. Explanation. Reverse mortgages convert equity into cash. Question 14. The VA funding fee is, option A, always waived, option B, paid monthly, option C, required on all VA loans, option D, typically required unless exempt. Take a moment to choose your answer. The correct answer is option D, typically required unless exempt. Explanation. Most borrowers pay a VA funding fee unless exempt. Question 15. USDA loans are intended to promote, option A, investment properties, option B, rural home ownership, option C, urban development, option D, luxury housing. Take a moment to choose your answer. The correct answer is option B, rural home ownership. Explanation. USDA loans support rural housing. Question 16. A buy-down is used to, option A, increase loan amount, option B, temporarily or permanently reduce the interest rate, option C, increase interest rates, option D, eliminate closing costs. Take a moment to choose your answer. The correct answer is option B, temporarily or permanently reduce the interest rate. Explanation. Buy-downs reduce interest rates using prepaid funds. Question 17. A temporary buy-down affects the interest rate, option A, for the life of the loan, option B, after adjustment periods, option C, at maturity, option D, only during an initial period. Take a moment to choose your answer. The correct answer is option D, only during an initial period. Explanation. Temporary buy-downs reduce rates for an initial period. Question 18. A second mortgage is, option A, subordinate to the first mortgage, option B, only for investment properties, option C, senior to the first mortgage, option D, always unsecured. Take a moment to choose your answer. The correct answer is option A, subordinate to the first mortgage. Explanation. Second mortgages are subordinate liens. Question 19. Mortgage loan products vary primarily by, option A, advertising method, option B, interest structure, repayment terms, and eligibility, option C, state licensing rules, option D, borrower age. Take a moment to choose your answer. The correct answer is option B, interest structure, repayment terms, and eligibility. Explanation. Loan products differ in structure, Terms and requirements. Question 20. A rate and term refinance primarily changes: Option A, occupancy; Option B, interest rate and or loan term; Option C, a loan purpose; Option D, a property type. Take a moment to choose your answer. The correct answer is Option B, interest rate and or loan term. Explanation. Rate and term refinances adjust the rate and or term. Question 1. A prepayment penalty is a fee charged for: Option A, rate adjustments; Option B, paying off the loan early; Option C, loan assumptions; Option D, late payments. Take a moment to choose your answer. The correct answer is Option B, paying off the loan early. Explanation. Prepayment penalties apply to early payoff. Question 2. Under current regulations, prepayment penalties are: Option A, required on arms; Option B, always permitted; Option C, restricted or prohibited on most consumer mortgages; Option D, unlimited. Take a moment to choose your answer. The correct answer is Option C, restricted or prohibited on most consumer mortgages. Explanation. Regulations restrict prepayment penalties. Question 3. Non-QM loans are often used for borrowers who: Option A, have perfect credit; Option B, have traditional income documentation; Option C, qualify for FHA only; Option D, do not fit standard QM guidelines. Take a moment to choose your answer. The correct answer is Option D, do not fit standard QM guidelines. Explanation. Non-QM serves non-traditional borrowers. Question 4. VA loans are: Option A, automatically transferable; Option B, assumable with lender and VA approval; Option C, never assumable; Option D, only assumable by veterans. Take a moment to choose your answer. The correct answer is Option B, assumable with lender and VA approval. Explanation. VA loans may be assumed with approval. Question 5. A streamlined refinance is characterized by: Option A, cash-out features; Option B, reduced documentation and underwriting; Option C, full documentation requirements; Option D, higher interest rates. Take a moment to choose your answer. The correct answer is Option B, reduced documentation and underwriting. Explanation. Streamlined refinances simplify documentation. Question 6. Which loan type is generally assumable? Option A, FHA loans; Option B, conventional fixed; Option C, jumbo loans; Option D, non-QM loans. Take a moment to choose your answer. The correct answer is Option A, FHA loans. Explanation. FHA loans are typically assumable. Question 7. A qualified mortgage, QM, must, option A, include balloon payments, option B, allow negative amortization, option C, exceed points and fees limits, option D, meet ability to repay requirements. Take a moment to choose your answer. The correct answer is option D, meet ability to repay requirements. Explanation. QM loans comply with ATR rules. Question 8. An FHA 203K loan is used for, option A, cash-out refinances, option B, reverse mortgages, option C, investment properties, option D, purchase and rehabilitation. Take a moment to choose your answer. The correct answer is option D, purchase and rehabilitation. Explanation. 203K loans finance purchase and rehab. Question 9. A bridge loan is used to, option A, provide short-term financing between transactions, option B, avoid appraisals, option C, replace construction loans, option D, purchase long-term investments. Take a moment to choose your answer. The correct answer is option A, provide short-term financing between transactions. Explanation. Bridge loans provide temporary financing. Question 10. The VA Interest Rate Reduction Refinance Loan, IRRL, is designed to, option A, change occupancy type, option B, provide cash out, option C, increase loan balance, option D, reduce the interest rate. Take a moment to choose your answer. The correct answer is option D, reduce the interest rate. Explanation. IRRLs reduce the interest rate for VA borrowers. Question 11. An assumable loan allows, option A, rate increases, option B, loan payoff at sale, option C, automatic refinancing, option D, a new borrower to take over existing loan terms. Take a moment to choose your answer. The correct answer is option D, a new borrower to take over existing loan terms. Explanation. Assumable loans permit transfer of terms. Question 12. A construction loan is typically used to, option A, finance new home construction, option B, buy existing homes, option C, access equity, option D, refinance property. Take a moment to choose your answer. The correct answer is option A, finance new home construction. Explanation. Construction loans fund new builds. Question 13. A construction to permanent loan, option A, is unsecured, option B, requires two separate closings, option C, is interest only for life, option D, converts to permanent financing after construction. Take a moment to choose your answer. The correct answer is option D, converts to permanent financing after construction. Explanation. These loans convert after construction. Question 14. A cash-out refinance allows the borrower to, option A, avoid closing costs, option B, reduce principal only, option C, receive cash from equity at closing, option D, change occupancy. Take a moment to choose your answer. The correct answer is option C, receive cash from equity at closing. Explanation. Cash-out refinances convert equity to cash. Question 15. QM Safe Harbor provides lenders with Option A, presumption of compliance with ATR. Option B, guaranteed profits. Option C, higher interest rates. Option D, lower capital requirements. Take a moment to choose your answer. The correct answer is Option A, presumption of compliance with ATR. Explanation. Safe Harbor presumes ATR compliance. Question 16. An FHA streamline refinance generally requires Option A, a new appraisal. Option B, cash out. Option C, a minimal credit documentation. Option D, a property re-inspection. Take a moment to choose your answer. The correct answer is Option C, a minimal credit documentation. Explanation. FHA streamline programs reduce documentation. Question 17. A no-cost refinance typically means Option A, no closing costs exist. Option B, costs are waived permanently. Option C, lender absorbs all costs. Option D, closing costs are paid through a higher rate. Take a moment to choose your answer. The correct answer is Option D, closing costs are paid through a higher rate. Explanation. Costs are offset by a higher interest rate. Question 18. A renovation loan finances Option A, closing costs only. Option B, only land purchases. Option C, second homes only. Option D, home purchase and renovation costs. Take a moment to choose your answer. The correct answer is Option D, home purchase and renovation costs. Explanation. Renovation loans include rehab costs. Question 19. Recommending an unsuitable loan product may constitute Option A, unethical or unlawful conduct. Option B, a permissible marketing. Option C, competitive behavior. Option D, good salesmanship. Take a moment to choose your answer. The correct answer is Option A, unethical or unlawful conduct. Explanation. Unsuitable recommendations can be unethical. Question 20. Mortgage loan programs differ mainly by Option A, advertising rules. Option B, structure, eligibility, and risk profile. Option C, marketing style. Option D, state licensing. Take a moment to choose your answer. The correct answer is Option B, structure, eligibility, and risk profile. Explanation. Programs vary by structure and eligibility.